HELOC or RELOC if you're looking at a rental equity line of credit. If your first thought is interest rates, if that's your thought, don't get one, because that doesn't matter. If your thought is, do I have enough equity on the property to get a home equity line of credit? Don't get one. That's not the first thought. The thing that determines the first question that comes up before you ever do anything like take out a home equity line of credit, it isn't the current state of the market. It isn't what you expect to happen 6 months from now in the market. It isn't anything like that. So if those are your thoughts, interest rates are at a certain point, I expect them to do something. If that's the way you're thinking, don't take out a home equity line of credit. You're going to trip and fall on your face. The actual first question that comes up anytime you do anything like sell an asset to 1031 the gains into another asset that's similar, so you don't have any tax obligation on that amount that you 1031, or take out a home equity line of credit, or do a cash out refinance, maybe taking out a second mortgage instead of a cash out refinance because you don't want to touch the low interest rate on the first mortgage. All of those are questions that are factors in what type of lending will you use on that asset. The first question, this is the one that's the most important, and this is what you use to determine, is now a good time to take out a home equity line of credit? It doesn't matter if interest rates are 20 or 2. At 20% interest rates in the 70s or 3% interest rate in the 2020s, there were people who should and shouldn't get a home equity line of credit. Here's the question. Here's what you start with. What is the purpose of the money? What are you going to do with it? If it's to create bad debt, to buy an RV that you're not going to rent out, to take a trip, to buy clothes, to consolidate more bad debt, there's a time where that might make sense. But if your idea is to take out this debt because you have equity and you can make your life better by creating debt on an existing asset, then the answer is no. Do not take out a home equity line of credit at any point in time to create bad debt. First, you have to accept that there is good and there is bad debt. But I am making a video, but not today, when good debt turns into bad debt, because that's possible too. If you're taking out a home equity line of credit and you're going to create bad debt, my suggestion as a successful investor who reached financial freedom in less than 10 years, even though I wasn't starting in a really good position, which is what I'm trying to teach everybody that watches my content, you can reach financial freedom, make work completely optional in less than 10 years, even if you're not starting from a great position. That's what I'm trying to share. If you're looking at a home equity line of credit, a RELOC, HELOC, cash out refinance, or sell for a 1031 so that you can get money to create bad debt with, don't do it. That's my actual I don't want to say Dionism rule, as Matt, the lumberjack landlord, would call it, is don't do that. If you can create good debt, so if you take out a home equity line of credit to purchase a cash flowing asset, a dividend stock that you have confidence in, that has a track record, even then it's kind of a Schrodinger's choice. You don't know until you take a deep look at the asset if it's smart or not. If you buy a rental that will cash flow, does the debt on the rental create enough cash flow, enough of a positive yield to justify the debt on the rental that you're purchasing and the home equity line of credit or cash out refinance or the loss of the asset to a sale to a 1031 of the existing asset? Does that purchase justify both and make a yield make it worth your time? Michael Zuber did this on his Norris Drive property, where he cashed out refinance, took out more than he could to buy 2 other properties, turned the first one into an alligator where he says he lost money every month on that property, created an alligator. Overall, the other 2 rentals made it positive cash flow, but he says that's not the way to look at it. You want to look at each individual asset, but there are different schools of thought on that. So some people might buy an asset if it generates enough cash flow for both of the properties to have a positive yield. So depending on how you look at it, it could work. But here's where, in this instance, good debt can turn into bad debt. The next question, after when you look at a home equity line of credit, this is very important. So it's first, what is the use of the money? Are you going to create bad debt? Are you just doing this because you can, or are you going to actually generate positive cash flow on a good debt asset? The next question, this is to me just as important, but it comes next. Can you pay off the home equity line of credit before the rate adjusts? And this is where and I'm going to use a familial term of love in my circle, this is where every dingus goes, well, it's fixed rate for 10 years. Okay, can you pay it off in 10 years? Because what happens after 10 years? What happens to the home equity lines of credits that aren't fixed for 10 years? So can you pay it off before the rate adjusts? Because interest rates can be 20 in a year or 5 years. We don't know. We don't want to gamble on what interest rates do. They could be 2%. So you don't want to gamble on what is going to happen with rates. When you get your home equity line of credit at the interest rate it is, for the amount of time that it is fixed, do you have the ability to pay it off in that span of time? If not, then the fixed rate debt of a second mortgage might look more attractive. Or if for some reason you had a mortgage that had a really high interest rate and a cash out refinance that replaced the first mortgage, didn't double your interest rate like it would right now. Most people, there's like massively high percentages of people that have either purchased in the last couple of years or refinanced in the last couple of years, have mortgages under 3%. The majority have them under 4%. So a cash out refinance that replaces the first mortgage now in the 6s or 7s would be kind of stupid, right? But so a second looks more attractive then. So that's the other thing, is what is the debt for? Can you pay it off before the rate adjusts? So these are the first two things that you're going to look at. You're also going to look at, what is this going to do to your debt to income ratio? If you take out a home equity line of credit, do you then have the ability to purchase the asset that you want to with that money? Because 1% of what you could take out on the home equity line of credit counts in your debt to income ratio, even if you don't take the money out. So if you take out a $100,000 line of credit on your primary house or your rental, so a HELOC or a RELOC, which I don't know if it's a term, so I'm coining it today. You have $1,000 a month payment factored into your debt to income ratio, even though that's not what you're paying because you haven't taken any money out. The lender looks at it like you could take that money out and you'd have about a 1% payment on that debt. So what's the purpose of the money? Can you pay it off before the rate adjusts? Can you invest that money because you want to create good debt with it, not bad debt? If you have that $1,000, 1% of the amount of the HELOC, no matter what amount you take out, is going to count in your debt to income ratio. Can you still then invest? So if you're in your first 2 years of investing before you have rental income on your tax returns and you're a proven vetted landlord and lenders have faith in your ability to, find a tenant, screen a tenant, place a tenant, have a lease, stick to a system, maintain a property, so they'll actually consider 75% of your rents in your debt to income ratio, that home equity line of credit as a starting platform might hurt your ability to buy a rental. I don't say it will, I say it might, because you might have the debt to income ratio where with that added 1%, you're still able to purchase. If you're after those 2 years, it's really less of a factor because they're going to look at the rent, 75% of the rental income of the property you're purchasing too. So that's the other thing to consider. So if you're looking at taking out a home equity line of credit, here's another mistake that a lot of people make. They think of it as a reserve. So he's not on the show anymore, but there was a host before Ashley and Tony, Felipe. Been a while since I've said his name. I can't remember his name, but he actually looked at his lines of credit as a reserve. He talked about it a couple times on the show, on the real estate rookie show on BiggerPockets. And I think this is a really bad strategy. And because of this train of thought, the economic event that occurs that could make you need to tap into the home equity line of credit to use as a reserve could be the economic event that causes the lenders to close it down because they could turn them off at any point in time. Right? They don't go, you borrowed $100,000 on your home equity line of credit. That's what you could take out. If you took out 25, we're closing it. So you have to pay us the 25 immediately. That's not how that works. They go, if you could take out 100,000, but you took out 25,000, they close it down. You now can no longer borrow the other 75. So the 25 is paid back as the HELOC was set up. What this also does is turns that into a 100% credit utilization on that line of credit, from a 25% when you had 25,000 out of 100,000. So it has a couple of other things to do. So is this the right time to take out a home equity line of credit? If you are looking at your first, second, or third rental, it's almost like I say, don't Tap into your retirement accounts. Don't empty them. Don't buy a rental, even though it's what you do. In my opinion, once you have your systems in, you learn the basics, you have confidence in your ability to get the return that you expect. I emptied out my retirement accounts in 2020. I'm going to empty out what's left from the last couple of years because I still contributed for the match. So what is going to come out now is going to go to work into a rental. I don't suggest doing that with your retirement accounts or the home equity line of credit or a cash out refinance on your first, second, or maybe even third deal, because this tends to be when we make the majority of our mistakes. So here's the short summed up version at the 10-minute mark or so of should you take out a home equity line of credit? Not to create bad debt, not while you're still learning your systems. Only if you're going to create good debt where you can pay off the home equity line of credit before the rate adjusts and the asset that you're purchasing creates enough yield to justify the debt on what you're purchasing and the added debt on the existing asset. Don't go anywhere during the live stream. I made this so I can cut it out, make its own standalone video. So I'm doing an outro really quick, and then I'm going to get to the questions, and I'm going to do this live stream is going to go on as long as the questions do. So if you're watching this in Futureland and you see that this was a short video and you want your questions answered in real time, Tuesday afternoons, 4 p.m. Pacific, I do my live streams that last as long as the questions do. I hope this video at least made you think, and I'm going to edit that. I hope this video at least made you think. Until my next video, thanks for coming to my Dion Talk. Howdy, present time people, not future land. I hope everybody's having a good night. I'm excited about this. This is the one thing during the week that lets me know it's Tuesday. And it threw me off a couple of times in the last couple of days because I've done some live streams and I would sit in here staring at the screen thinking, is it Tuesday? I don't think it's Tuesday. And did you know that if you spill water on your computer, it doesn't like it? Even if it's actually water. Lauren, howdy. Hope you have a good night at work. Sorry you can't be here. Greetings, Corey. Howdy. Dividend Dave, you're here. We could start. I don't need to sum up the last hour, although you could probably do it for me now. Brian, laser focused. Howdy. Cody Knight. Howdy. Had my first investment property for 6 months. Congratulations. I'm sure this is when you have your biggest challenges. And now I'm facing 3 evictions. I take full responsibility and thought out all my newbie mistakes. How do I get in the right mindset? Again, motivated about REI. In the last couple of weeks, I've made a couple of videos on what were the first 10 years like. And a lot of that was focused on, they suck, right? It's really slow. And my first year was so bad, I tried to quit. I made a video on Zuber, one rental at a time, his channel, literally titled, Why I Quit Real Estate. And it was because that first year was really bad. The big difference between what you have going on and what I had going on is I hadn't found YouTube University. I didn't know that there were other people that dealt with this, who dealt with evictions, who built reserves, ran their cash flow accounting for repairs, maintenance, and vacancy so that you can handle things like this. So it's hard to understand. I totally get it. In the first few years, when you have a big maintenance item, or, like when Cody and Christian Multifamily Strategy purchased the Robin Hood Resort and they have a septic issue right away, it feels like that money comes out of their pocket. When you have these evictions and you have this rent, these rentals for 6 months, this money feels like it's coming out of Cody's pockets, Cody Knight's. Why did I say Cody? My brain mixed those up. So it feels like it's coming out of your pocket, right? Try to have the mindset that, yes, this year it feels like that. So this is kind of your cost to acquire expenses, right? So you can calculate this and see what your yield change to. But as you've owned this for a period of time and you have that 10 or 15 or 20% or whatever you're setting aside, for me, it's 10% for repairs and maintenance, 5% for vacancy. So 15% is being set aside for that kind of stuff. As that account grows in the future, when you have a big maintenance item or repair or an eviction, that money covers the vacancy, that money covers the cost of the eviction, that money covers the cost of repairs for the tenant flip. And it doesn't feel like it's coming out of your pocket. And if you're having an eviction, it's kind of like every time, and this is a knee-jerk reaction that I don't know if is socially acceptable, but every time somebody says, oh, my life is changing, I just, got a divorce, instantly, congratulations. Like it just comes out. There's no stopping it as soon as I hear that. Because a divorce doesn't mean that a good marriage is ending. It means that a bad one is. An eviction doesn't mean you're losing a good tenant. It means you're getting rid of a bad one. So now's the time to have your systems to screen a tenant, place a tenant, build a relationship, adjust to area market rents. Sometimes tenant turnover is actually really good. I talked about this with Lumberjack Landlord and the Three Amigos this morning, where sometimes the right thing is to have a tenant turnover, even better than the binder strategy sometimes. Yes, I'm lazy and I don't want to deal with the tenant turnover, but if market rents have adjusted so much that the binder strategy will, even if it goes really well, at a $500 or $600 a month increase that the tenant asks for, so the tenant can ask you to raise the rent, that might still only be another $500 off of market rent. So in those cases, it's better for the tenant to move out. So congratulations on the evictions. It sucks that you're going through them. In the future, it won't feel like you're paying for them. That's how I would get around that. Think of you're 6 months in, you're getting all these lessons right away. So you know how the eviction works in your system now. You either did it yourself or you have an attorney. So you have an attorney on retainer. You know what kind of verbiage to have in your leases. You know what led to these evictions. You are now starting from experience, which is something I hear often, but you're not starting over. You're actually continuing on, but now you know more. I have faith in you. Tom Kine, howdy, drive safe. One-liner hider, you're here, but you're in an internet dead zone. I have been in a couple of those trying to do live streams. It doesn't work so well. I was in Alaska. I was on a cruise, went to Alaska and went on one of these, the longest, what are they called? It's not a sky train, because that's stupid. The carriage thing that goes up in the air. And we went up to the top and it was next to a cell tower. And I thought, okay, we're standing next to a cell tower. I'm totally going to do a live. This is going to be great. The thing starts going down and it goes so fast and so far that we lost cell service before we got to the bottom. That was not a very good live stream. Mark, Basio, Tiffany, howdy. Tiffany, reach out to me. We need to schedule. All Night Hider says, please hit the like button because every time you do, an angel gets their wings. And someone retires before Mad. Chester, howdy. I will let you know if some things come up to block. All-nighter, thank you. Peter, howdy. Chester, debt is amoral. Its use determines its purpose. Absolutely. It's a great way to put it. It's like a firearm as a tool, right? It can save you. It can protect you. You can have an accident with it. You can have an accident with debt. Although, I don't know if that fits. I don't think if that makes sense. I'm just going to say it. When I went through the divorce and I found out several $100,000 in bad debt, I would have rather found out about several firearms I didn't know that we had. That would have been way better. Rick, howdy. Cougar View. Probably said that wrong. I think you've discussed this before with one rental at a time, but before buying a duplex, you need to have a plan to get out if it gets bad. How would you plan for this? When we buy a property, one of the reasons lenders want you to have reserves is so you can handle problems when they come up. Your exit strategy, I think, is really important if you're doing a flip. What if rates double? What if home prices drop? What if your rehab takes too long? So your exit strategy needs to be something like, what if I turn it into a rental, right? A couple of years ago, property listings, I think it was 1% of listings that didn't sell turned into rentals, and now it's like 14%. So a larger percentage of people are turning properties that won't sell into rentals, so they had a different exit strategy. If you're buying a duplex and it doesn't work, cash reserves is huge. And understand that if it doesn't work, you want to make sure that it takes as much time as possible for it not to work. It's not like when you're looking at a contractor or an employee where you want to hire quick, fire fast, or hire slow, fire fast. When you purchase a property, especially if you're doing an owner-occupied low down payment, you start out underwater because it costs between 6 and 8% to sell a property. So if you do this right away, you get into it and you don't like it and you want to sell, you're going to lose money. Right, the time for appreciation and principal pay down hasn't happened to compensate for the 6 to 8% that it's going to cost to sell the property. So I guess it would depend on. You said just before, if you're buying a duplex, you need to have a plan to get out of it if it gets bad. What would you mean by if it gets bad? Can you not find a tenant? Is it in a high turnover area? Did you purchase it and had existing tenants who aren't paying or forcing you to go through an eviction? So most of that comes down to having reserves. That's why I don't like the comments when people say, how do I buy a property with low or no money down? Right. And this is not a popular opinion. And it's not that thing where you go, it's not a popular opinion, and you say things that everyone's thinking. This is, if you can't save the reserves, the down payment, the money for closing costs, the money for immediate repairs, you're not going to magically start saving once you have some cash flow from a rental. You're going to have 3 evictions like Cody did in the first 6 months of owning it. You're going to have, this went bad, how do I get out of it? Learn how to save before you have the assets. It's a part of saving first, which doesn't mean spend less money. It means make more money, increase your income, develop a side hustle, work overtime, get a different job, change company, something to increase your income and decrease spend. Like those things go together. Doing that before you have the properties to make sure you have an exit strategy. If you're doing an owner-occupied house hack and you can't move in, document it. Have a reason in case it becomes an issue with a lender that you didn't actually owner-occupy. Because remember, when you purchase, it is you intend to owner-occupy. I have a friend who purchased a duplex, house hack purchased, lower down payment, went to move in, had to do an eviction on the tenant was there, cash for keys didn't work, had a month-to-month lease, it was an eviction. The guy was kind of big and scary and she didn't want to move in, so she didn't. That's a justifiable story. She didn't want to live where that person knew where she would live. Her intent when she bought it was to move in. So don't commit fraud. Don't purchase a place saying, I intend, and do the air quotes, to move in. Actually intend to move in. But if something changes, your exit strategy can be, turn it into a rental. But here's why. Like, have a justifiable reason. And I see that Brandon jumped in here with a super chat, which I appreciate early in the video, because that kind of shows YouTube, hey, show this to some more people. I much appreciate that. Deal analysis, withdrawal from a 401k. Do you need the rental property to cover the taxes incurred with the draw of the penalty? That's a great way of thinking of it. And yes, so if you're taking money out of your 401k or anything that's going to be taxed, the cost of that asset, like if you sell for a 1031 exchange, a lot of people go, my property is worth $400,000 and it's paid off, so I'm going to sell it and I'm going to take that $400,000 and put it down on an 8-plex or a 10-plex in my area, right? So that's going to be the down payment. When you sell that $400,000 property, 6 to 8% in selling costs. So let's say, so we're going to average it 7%. So 7 times 4, $28,000 right off the top for selling costs before you even get into the cost of a 1031 exchange. You have to hire a 1031 company to run that for you. That might be $7 or it might be $3,000. It's somewhere in between there, right? Because I haven't done one. I'm not going to say what it is, but it has an expense. The cost of the sale of the asset, or the cost of the transition of the equity from one asset to another, has to be factored. And when it's a retirement account, that's where people, I don't want to talk about it yet because it's too soon. Hypothetically, let's say you had a tenant that called you and said, I'm taking a loan against my retirement account to pay my rent because they want to have a month without a rent payment. That's somebody that shouldn't be doing that, right? That's somebody who's probably going to need the retirement account when they get there because they're not making good investment stuff now. Because when I'm talking to my tenants, this thing actually confuses almost everyone I know. Every interaction I have with a tenant, I'm trying to talk them into buying properties. I think everyone that we interact with, that we can get into real estate, that can start getting on the financial ladder, the property ladder to get their finances better. The world is just a better place if people get enough finances figured out to where they can have the job they want instead of the job they have to do. But cases like this, I've even told these tenants, I've said, look, let me help. I'll introduce you to a lender. I'll find, we got some great agents here and they're just not interested. They shouldn't be doing that, loan against their 401k for that. But if you're looking at purchasing a property, you have a couple of different options. One, there is you self-direct a retirement account to own a rental property, which I say don't do because it's a bad idea. You lose most of the benefits to owning real estate. Can't self-manage, can't house hack. Depreciation, like the benefits of owning real estate are off the table. So it's not a good idea, but some people do that. And then you take a loan out against your 401k, so you're going to pay it back with interest. Who gets that interest? That's something worth knowing. So you have to cover the cost of that interest on the asset purchase. If you do like I did in 2020, I took the money out, had the 10% penalty waived because yay, COVID, which you can't say or you're demonetized. But I paid the taxes. I happily wrote a check to the IRS and said, look, this retirement account is being emptied out, and pay the taxes, and I put the money to work in a rental, right? The cost of those taxes was factored in to the cost to acquire the asset. Absolutely. So it's a great question, because it is a great way of looking at it. Rick, good evening. Wandering Doc, howdy. I'm seeing home equity line of credits at 7 to 8% today. I had a HELOC at 1.9%, 1.99% before. Right. So the interest rate is a factor, but it's not the determining factor on, I would take out a home equity line of credit at 20, at 100%. 100% HELOC, I would totally do it if it met those other two criteria. First, what's the purpose of the debt? Is it going to go into good debt? It's going to create good debt. Second, is the cash flow, the yield on the thing that I'm purchasing going to justify the added expense of having that home equity line of credit? So it doesn't matter what the interest rate is, whether it's 1%, 10%, 1,000%, if those two questions are answered with the correct answers, because then the deal's worth it. If you're at 100%, or 10% or 7 or 8, it's probably going to be harder to find that deal, right? So you're not going to be able to answer that question and actually do that. So I would, if I could found the deal, right? I've not used a home equity line of credit, cash out refinance, or sold for a 1031 because I don't want to recycle capital. I don't want a bigger portfolio. I wanted the cash flow that got me freedom. So it's one of the biggest divergence between one rental at a time, lumberjack landlord, millennial Mike's theories, processes, and my way of doing things. I'm not right. Guarantee I'm not right. Most people watching this kind of content are going to benefit from recycling capital, not on the first or second deal, right? But once you have your systems down, totally makes sense. I think millennial Mike nailed it when he goes, I'm gonna get some assets. I mean, he's house hacking a local. He's investing out of state. So if you want to know how to do that, he's the source to go to. He used another person's systems to get that trust in learning a market. And he has a couple of years of experience under his belt, has the systems in place, and then he does a couple of BRRRRs, right? Don't start with something that's risky, has a lot of ways for you to trip and fall on your face. But once you have the basics down, that's when you start looking at those. So while I haven't done a home equity line of credit, I haven't done a cash out refinance, I haven't done any of those, I'm more likely to now with a portfolio in place that can handle mistakes than I was 5 or 10 years ago. And I see Sheena. Howdy. Hi, Dion. My husband, make sure I'm not missing a question here. My husband and I appreciate your content. I'm getting a phone call. I have to say no, they don't know I'm in live. I should answer it though, it's my son. It would probably be great for, no, I'd probably end up in jail. Appreciate your content. Question to follow. Awesome. I have a somewhat similar situation as your first year investing, except I have family in my property. Who can trust a stranger? When we first start out, we rent to someone we know because that just seems smarter. So welcome to the club. We made a mistake. I make no cash flow from it. They pay exactly what the bills are. They will be coming up on 2 years in the unit. Will I be able to still use that rental towards my debt to income ratio? Do you have a lease? Do you have proof of the deposits? So 75% of the rents that you've been consistently receiving and can prove that they're, I have a nephew, I had a daughter, a nephew. Like I have family members that rent for me now. Don't start that way. Don't until you develop a backbone and get a system in place and have your leases and stick to it and make an actual contractual verbal agreement that this is the lease we're sticking to. Relationship doesn't mean anything. Don't rent to friends or family. That's what I learned in the first year. But that debt, that income, that rental income counts in my debt to income ratio with the lenders because we have a lease and I have proof of deposits. So have a track record for that. And you are making some of the same mistakes that I did. First, renting to a friend or family, they're getting a great deal if they're paying your debt, right? So here's something you're not going to like to hear. Let's say your mortgage is $1,000 and they're paying you $1,000. It's a wash. You're not setting aside money for repairs, maintenance, or vacancy. So yes, people would say you're losing money. You have to pay taxes on the income that covers the principal pay down. Right? That's not a write-off. Yes, depreciation is probably going to take care of that to where you actually don't, but that's something that some people haven't thought. If you have a paid off property or you're at the end of your depreciation schedule and you're getting rent that's equal to the mortgage and you're paying the mortgage, the principal pay down is not a deduction. So now you're paying taxes on the money. So they're not even breaking even. It's less than that. I would use the binder strategy on family. And I would say, look, you're probably not going to get the increase that you expect. I still need to make the video with my two friends who the tenant suggested a rent increase and both of them said, that sounds great. We're going to go less than that. Like they talked the tenant down from what they suggested. I think I've done that once too. I'll have to go through my records to make sure before I say that. So I think it's a thing. Did I do that? I did. And I had my son with me. My memory sucks. Show them what area average rents are, because they're probably looking at it. Yeah, your mortgage, and I'm using the wrong numbers because I don't know your exact story, but they're saying, yeah, your mortgage is 1,000, you're paying 1,000. Sounds great. Then you go, well, here's what's happening to property taxes. Here's what's happening to insurance. I'm actually paying taxes on principal pay down. That is not a deduction. Here's what rents are in the area. So if they're getting 1,000 and that's your mortgage, rents are probably more than that. So you show that to them and just ask them what they think is fair. You might be shocked that they come back with a number and you go, that sounds great. That's probably too high. Let's come down a little. But now you have some profit in there, or at least get up towards break even, because you're going to have expenses on that rental. And if you're not setting aside money from gross rents for that, you, like Cody is paying for those 3 evictions in the first 6 months, are going to be paying for those problems. Hope that helps. Financial firefighter, aloha. Get your feet wet first. Yeah, you did the retirement account and got like 14 units in your first year. So it's entirely possible, and now take some time and stabilize. See where I was in the chat here. I like it when it moves. Yes, Chester, fresh water that you don't want to spill on your computer. Luckily, I use mechanical keyboards, so they're easy to clean the water out of. Well, it evaporates pretty well. Success is Janelle. Howdy. Love the name change. Yes, HELOCs on rentals are available, but CLTVs are usually around 70%. So that's loan to value. Credit loan to value. I forget what the C is. 70% rates will be higher than owner occupied, of course, right? So there are lenders who will do a line of credit on a rental because it's just an asset-based line of credit, and you are going to get a lower than you could on owner occupied because you're more likely to lose a rental in the mind of lenders, and you're probably going to pay a higher interest rate. Good point, Rick. See, this is why I follow you. Nobody else talks about these things. I had no idea that they count 1% towards your debt to income ratio. Yeah. Since I haven't used a home equity line of credit, I wouldn't know that either, except I'm in a mastermind group that meets weekly, and I'm in it at least twice a month probably. And there are some lenders in that mastermind group, and they talk about that kind of stuff. So I literally sit back. I'm the one going, oh, what is that? How do you do that? And then I know what to look up. Yeah, so that can have an impact. Sierra, howdy. Can you talk about putting the bank in first position? I've heard you mention that a few times, but I think I've always seen my name in first position. Right, so you own the deed, right? So you're not in any kind of position. You just own the deed. Bank is in first position on the deed if there's a default on or a problem with payment. So that's why they call the first lender, the top lender in that is in first position. You can have lenders in second position. You can have seller financing where the seller is in second position with the 50-40-10 rule, but you're not in the A position. You might be in the first position on the paperwork when they're doing it. But when we talk about first position, it means the first lender that has ownership of a portion of that deed based on the debt that's owed to them, which for me is a form of asset protection. Right. That's why one of the reasons why I don't want to have paid off properties is because the bank is in first position. It's kind of like, I don't know if you know this or not, but when police officers are filling out an accident report, there's a slot for the vehicles, right? So this vehicle, second vehicle, third vehicle. It's an unwritten thing that the person that the police officer thinks is at fault, but you can't articulate it, goes in first position. So if you're ever in an accident and you see your name at the top, it means that police officer is telling those insurance reps, this is the person we think goofed up. 8 years as a cop, I'm sure I know a few more things than that, but that's one that I took away. Wandering Doc. Most home equity line of credits are fixed for 10 years, most, but not all. So they're fixed for 10 years. What happens in year 11? The problem is not paying them off on time. Exactly. The problem is they used to be lower than 30-year mortgages rate, and now they are higher. Great point. Matt, howdy. Regarding seller financing structure, high price, low interest rate versus low price, high interest rate, assume same monthly payment, advantage, disadvantage, taxes, depreciation, property tax, readjustment, etc. So I would never want to pay more interest for the tax benefit. If you are paying interest, use the tax benefit, but I don't want to pay interest because you pay $1,000 to get a $300 benefit. That's the math, right? That's not good. If you're doing seller financing, one of the benefits is it's not just low down payment. I actually saw that on social media today. So let's talk about how it's not just about the low down payment. It's the seller is probably being educated by you on how seller financing works. So don't bring up balloon payments. That doesn't have to be a thing. Don't bring up the interest rate that has to be somewhere around what banks are paying. It could be 1% and banks are at 5 or 6, right? Because it comes down to what you and the seller can agree to. The benefits to seller financing for me is it doesn't count in the 10 mortgages in your name. It's not Fannie Freddie backed. It can get you around things like debt to income ratio, credit score, your work history. There's all kinds of other benefits. The cons, you're educating the seller. You're probably going to have agents that think it's illegal, think you're trying to get around paying their commission. So you kind of have to come into that, combating that to get the deal accepted in the first place. You have to find the seller that's in the right position. Seller financing doesn't really work usually if they have a bunch of mortgage debt left. You can do the subject to where the, or the, the versions of debt where it stays in their name. You continue to make the payments. The lender doesn't even really know or care, doesn't need to, whatever that format is. You could do all these creative things, but it's finding the person that's in the position to do it, that doesn't think it's illegal, whose agent doesn't try to talk them out of it. That's the cons, is it's harder. Kind of like it's really subtle. But if you come to a purchase and you say, I have a conventional owner-occupied loan, I'm going to do 5% down to move into this house. And somebody else comes in with, I have an FHA 3.5% down, or I have a VA loan 0 down. The thought is that FHA and VA have more hoops to jump through to get it approved, right? Everything has to be live-in ready, water heaters have to be strapped, like all these, some other things that can come up. They're trivial usually, but the seller will go, nope, the conventional, it has less hoops to jump through. Even sometimes more important than offering more money on FHA or VA. So it's not that they don't support troops, so they don't want to help people that they think are first-time buyers. It's the loan product is harder to deal with. Go with the easier one. The amount of money isn't always what's important. Sometimes it's ability to close, ease of closing, those kind of things. So I often hear people go, I'd rather buy a low-priced property at a high interest rate so that later I can refinance to a low interest rate than buy a high property at a low interest rate. We have no guarantee that interest rates are ever going to be below 10. They could go to 10 and be there forever. It's a gamble to think that they're going to be low. We have short memories. We know that they were in the 3s or 2s in the last couple of years, so we expect that to happen again. But how many decades was it since that happened before, right? Don't gamble on needing something to happen in the market. Does it make sense in cash flow now at the price and rate that you could buy it at now if it had to stay there forever? And then, well, no matter where the rates are, you watch rates. It might make sense at some point to refinance. It might not. Test rooms, air trim. No, there's another thing for it. I'm sure I've mentioned memory issues. So there's a post-it here that says it's Tuesday, which doesn't help when it's not Tuesday. The Yoder, howdy. We used our emergency fund for a down payment on a rental, kept the home equity line of credit as an emergency fund. Thank God we didn't need it. With cash flow, the emergency fund is fully refunded. Nice. So I did something similar. I talked about it on One Rental at a Time today, or Lumberjacks today. I forget which video it was in. So they'll be coming out soon, where I dropped down to $200 in my saving account when I was buying a property. Don't do that. Especially don't do that on your first few deals. There's a couple of reasons why I did it. I had 4 rentals already. I had positive cash flow, had reached financial independence, maybe not financial freedom, but financial independence. I had $17,000 in credit cards that it wasn't used. I've never carried a balance on it. I had a retirement account that the lenders used as a reserve without having to tap it or take it out, right? And I had a good job. So I had a good job, cash flow. We closed on the 6th of the month. So I got the rents prorated from the 6th to the end of the month on a 4-plex. And then I got the next month. So I got January's, most of January's, and all of February's before there was a mortgage payment due. So by the middle of February, I had 10 grand in the reserve account. But I knew the timeline of how this had cash flow, good job. and the place was already occupied that I was buying. So it made sense because I also had the retirement reserve. If you do that in the first couple of deals, you're probably going to file bankruptcy and lose the property. Right? That's the more likely outcome. So yeah, you can use the home equity line of credit as a reserve. Sometimes lenders won't let you because they look at the debt to income that you could borrow and that it could be closed down at any point in time. But you weren't the lender. If it worked for them, that's great. Yeah, once you have a few deals and you have the systems down for this is what I have confidence that this is what's going to happen. You can, and I don't want to say be more risky, but you can be more creative in going lower than. And here's the numbers. Like when I first started, I was making $17 an hour and had a bunch of bad debt and had been laid off from the police department. I was like, I'm not in a bad position. So when I saved like $28,000 over the next 2 years with side hustle and overtime and finally figuring out my house as a rental, the first year sucked. Second year, I actually made some money. But then using that money to buy the duplex, that would be like what I would tell most people. My life savings was $28,000 and I got this. So then you flash forward 6.5, 7 years, and I'm buying the fourplex, and I'm like, I have $141,000 in my bank. That's a number that most years of my life I would have said, oh, if somebody has $141,000, they probably never have to work again in their life. That's so much money, I'll never see that. Well, I had it, and I purchased a place and had to put a roof on. I knew that it needed a roof buying it, so it was in my cost to acquire, and the closing costs and all that kind of stuff took me down to $200 to my name. Imagine being $17 an hour, not making a lot of money, single dad with 3 kids, and you somehow magically in about 8 years have $141,000 in the bank, and you spend it all, right? Because at the time, that was what it was. When I was buying things, I thought you spend money on an investment. I didn't realize my $141,000 is pretty much still there. It's actually way more than that, because put the roof on it, it appraises at 100 and something thousand above what I'm borrowing at. And now it's almost doubled it's over doubled in value. Yeah. So the numbers become unreal. That's why I'm trying to get everybody to the income snowball, because it just gets harder to even kind of understand the numbers in a good way. Jace, howdy. I'm up to 5 long-term rental properties. Awesome. 13 units, all 80% leverage. Good. That's a little high for me. I would like this. I like when I was in growth mode, I liked 70% loan to value. Debating on holding off buying more and either paying down debt or saving for a larger purchase later. I have a home equity line of credit with $40,000 available. Now, what's my advice? So I don't, like every other YouTuber out there, random guy on YouTube, don't take any of this advice. This is not advice. This is what we would do in a similar situation. What I would do in a similar situation. Don't sue me, bro. So I wouldn't look at the home equity line of credit as what do I do with it. I would look at it as since you already have it, it's kind of an emergency fund that could go away at any point in time, is impacting your debt to income ratio. You have 5 long-term rental properties with 13 units, 80% leverage is a bit high for me. I don't know that I'd focus on paying down the debt. I'd let the tenants do that. I would take some time, study your market, keep an eye out for great deals. There might be a seller finance deal that pops up. There might be the most amazing deal where partnership looks good, right? You don't know what you're going to find unless you're actually looking. But let time impact your debt to income, not your debt to income, your loan to value, because you have appreciation and principal pay down happening, which can vanish like it did in 2009, right? So we don't count on that as your actual net worth that you're going to eat. You can't eat net worth, but you can eat cash flow. Allow time. I probably wouldn't look at doing anything with a low down payment for a while, or using the home equity line of credit as the down payment, because that is going to keep your loan to value high, because the home equity line of credit is also debt, right? Continue saving. And this is where I'm kind of different than most of the other creators out there that are like, recycle capital, take out a HELOC, sell in 1031, do a cash out refinance, do all these things. And you're at 80%. Well, you can find somebody who'll lend you 90%. You can put 10 more cents to work. No, that's not what I'm saying. I'm saying in growth mode, I would like to be around 70% loan to value, so that you can handle up to like a 50% rent reduction and not have to dip into your own pocket. Look at your numbers right now. The money coming in gross rents versus what's going out for mortgages and setting aside for repairs, maintenance of vacancy, or property management, whatever you have, take that out. Is what's left able to go down 50% from gross and still be positive or break even. That's kind of hard to do when you're 80% loan to value, but at 70%, it's kind of possible. When I retired and I stopped having the W-2, which has been 6 months now, yay, congratulations, me, 6 months. It feels like 6 days, but 6 months ago, I retired. I increased my reserves. I reduced my loan to value. Yes, that's the right way to say it. My goal is 50% loan to value being retired, so that I can even handle more than a 50% reduction in rents. So if I owe $1 million, I want to make sure my gross value of properties is over 2.3 million, so I can handle the cost of selling and any taxes that are in there, and still walk away with, like, that's half. So 50% loan to value. I'm about like 40. So I owe 1.8, gross is like 5.6 or something like that right now. But that can go away. Appreciation can disappear. So that would be my concern. 80% is a bit high. I would look at saving a large down payment for the next one. So I'm at 40%. I want to be around 50. I want to be gaining appreciation on multiples of what I invested, but I don't want to be over leveraged. So that's why I'm not at 70 anymore, because I don't have the security of a W-2 job, which is a sentence that never one should ever say, because there is no security in having a W-2 job. If you're having to sell your life 1 hour at a time to make money, what do you do when nobody's buying? That should be a short. I'm probably going to finally use my VA loan and purchase a property with nothing down, which should bring me from 40% overall loan to value to 50% loan to value, which is where I want to be. If you were at 80, I would look at doing a larger down payment. So even if you had something like owner occupied, FHA, conventional, VA, and you could do a low down payment, I would save 15, 20%, have a better leverage position on the next purchase. Rob, saving for down payment sucks. It really, really sucks. It really, really does. But having a lower loan to value, a better equity position, the ability to handle a bigger rent reduction, which we've never seen, but we want to plan on happening, doesn't suck. Oculus, howdy. Brandon, time value of money calculated. Deal analysis. Oh, do you need the rental property to cover the tax? Yeah. Okay, so that must have gone with your super chat. Exactly. And all-nighter, thank you for thanking people when they do a super chat. It's much appreciated. That's why you're a moderator here. Oculus, besides getting an attorney to add eviction language, thank you for watching my content, to leases, what are your thoughts about finding a good real estate attorney? Have you had to use an attorney or considered one to your virtual team? I have one retained. I contacted them and I said, hey, what would you like to in the lease to make your job easier? So added their verbiage. So that's something I learned from my brother, who's a successful investor with 10 rentals paid off and is retired, been retired for like 8 years. So smart advice that I took from him. So it's not credit to me, it's credit to him. He probably learned it somewhere too. But having that attorney there, it helps you sleep well at night. So it's part of the SWAN account, right? So the reserves is a SWAN account, a low equity position is a SWAN account, cash flow is a SWAN account, having a plumber that I know has 24-hour service and what the rates are, it's a sleep well at night account, right? So the same thing with an attorney. I have not had to do an eviction, but I have friends who have. And I actually just referred a friend to that same attorney that I have retained to go through an eviction. I thought I was going to do the serving, and then they were like, oh, you have an attorney, we're just going to pay. So sucks my friend got a bunch of money instead of evicting somebody. To find a good real estate attorney, though, like that's I think the crux of your question. Reviews, are they actually associated with real estate? I mean, don't go to a family court law person for real estate. You would find a real estate attorney, look at reviews, talk to other investors in your area, because that's why it's one of the main reasons you don't want to call any attorney and just go, hey, what should I put in my lease? Because my attorney in Thurston County, Washington is not going to help somebody who lives in Spokane, Washington, or Montana, or any other state, right? They know their court system in their local state with the local laws. Doesn't mean they can't answer advice. So there might be some YouTube channels with attorneys like Rylis that gives great information, especially if you're going to do anything that has anything to do with probate. I watch Rylis for that, right? Go get his information. But he's not in your area, unless he is, but he's not in my area. So if you're going to deal something with probate, find a local attorney that deals with your courts. and probably talk to local investors, local REI meetups, local Facebook groups, social media to find, other recommendations from people who have experience with those attorneys in your area, almost like any other contractor. And then try not missing a super chat here because that would feel horrible. That lumberjack landlord, howdy. Thanks for hanging out with us. 1031s are about $1,000. So there you go, regardless of size of the exchange. Good. So it's $1,000 expense that you add to your cost of that process, which you pay even if it ends up not being a 1031. What if you don't hit your timeline? Right. So it's a cost that could happen whether you get the sale or not. Rob, howdy. So Dion, when you and Mike go to the Robinhood event, are you going to talk about BRRRR, Cody and Christian's style? Every time I talk about BRRRR, I say it's a great strategy, but not one to start with. So I don't say the strategy sucks. I've actually, at the beginning of this video, if you were here, I was talking about how Millennial Mike did it absolutely right. Got into a market. First, he's house hacking. I think that's the first suggestion that I like to make to people. But Millennial Mike invests in another state. You're piggybacking on somebody else's that he trusts strategy using, going to Matsky from Matsky Finance, because they both worked in law enforcement. They just have this kind of this relationship where he could trust the boots on the ground, right? After he has several rentals and he's done some rehabs and he has faith in his ability to get a return, he does 2 BRRRRs. That if you were brand new, these BRRRRs would have blown up in your face. He started them when interest rates were in the 3s. He went to do the refinance and interest rates are in the 6s or 7s, depending on what you buy down rate. But since he has the systems in place and he has the cash flow and the reserves and he knew how to do everything in this way, he still won a successful 2 successful BRRRRs, even though interest rates basically doubled. That doesn't happen on your first or second deal very often. So if I talk about it at Cody and Christian's event, which is this Saturday in Union, Washington, which I don't know if they've fully booked, I need to check. You can go for the 21st, which is just Saturday. Me and Millennial Mike will be presenting, and there'll be some other presenters where you can go and book a cabin for the whole weekend and hang out with Cody and Christian, multifamily strategies. Have tons of great information, especially when it comes to seller financing and building those relationships. They've got skills I just don't have. But if BRRRR comes up, I will talk about, because I've got a video on my channel, how to BRRRR and why I don't. Right? I don't think it's a bad strategy. I think it's a bad beginner strategy. There are several ways where you can trip and fall on your face. Just the first ones that come to top of mind. Interest rates can double by the time you're done with your rehab. Your rehab might take longer. You might have underestimated the cost of the rehab. You might have overestimated the cost of your after repair value. You might have messed up the timeline on how long it's going to take to finish the project. And for the last 10 years, we're kind of in an uptrending market where the more mistakes you made, the longer it took, the better you look like you did because the market fixed your screw up. That might not be happening now, right? So that's how I talk about BRRRR. Great strategy, but don't start with it. So yes. Majid, howdy. I have 7 single-family rentals. Awesome. My repair works normally on appliances like dishwasher, fridge, AC, etc. How one handyman has skill for all different works. How your handyman handle this? So I have a handyman that subcontracts out a few things, depending on what's legal in your area. Make sure that they're allowed to and that they're licensed to do that, and that the person that they sub to, they're basically just hiring, has the license to do it. So my handyman has an electrician. Right. So he doesn't go into the electric box, but I get a bill from the electrician that he says that this was beyond my ability. This had to be done in the panel by the pro. So that's how my hand. The thing is to have a couple of different handymen, and you, not your handyman, you need to know the bandwidth of your handyman. I have a guy who's amazing with carpet and LVP. Like I purchased a place and it looked like somebody kind of threw carpet in there. And normally I've ripped carpet out and put in LVP. But he says, yeah, give me $200. I can make this look like a trampoline. And he did. Right. Tenant was there, super easy. Went in one afternoon. Somehow, I'm not a carpet guy, but this thing, like you could drop a coin and it would bounce on this carpet. So it looked great when he was done. But if you put him on trim, it looks like a monkey went in there with a sledgehammer. So I don't have him do the trim. And then I have another handyman that has, great work and will do crawl and crawl spaces and do, ducting or whatever that doesn't require, technical plumbing skills or something like that. But he's clumsy, so I'm not going to have him do anything on the roof, right? So you kind of need to know your handyman and then have more than one. Not just because different handymen have different skill sets, but sometimes handymen have a job and this is their part-time thing. Are they available when you need them? So if you have a couple, you can call. And then sometimes you can call and say, hey, this is what I want you to do with that house. You've been there for other work, but I want you to put in like a divider between the 2 units in the back so they have a privacy fence. And he goes, oh yeah, sure, no problem, $2,500. And you're like, how much? You call your other handyman and he goes, $600, and that'll include materials. And you're like, oh, you got the job, right? So you have to have kind of options with your handyman, because sometimes they're not running a handyman business or running a contractor business, and they don't really get estimates. And I do have one handyman that every now and then will charge me way too much for something, but he's available at 1 o'clock in the morning on a Saturday when I'm in another country to go and fix stuff. So I'm like, okay, that one was overpriced, no problem. Other things will balance it out. And it's not always just about the price, that the time and their willingness to do things like go into a crawl space is as important to me. And then Tom Kahn, apologies for poor voice to text. Thank you. So there must be a question here somewhere from Tom that I missed. Taxes. So here's. And you can write education off for taxes. You can, right? So Dividend Dave, you have to let us know you work in tax stuff. And Dividend Dave is not an official name that you can be held accountable to or in court, I'm sure. But if you pay for courses, are they tax deductible? Remember, the question is not, is this a tax write-off? It's how do I make this a tax write-off? Kind of like you take a trip to Vegas. How do you make it a tax write-off? Well, if you're a real estate investor and you go and you look at markets and talk to agents, most of that trip becomes a real estate write-off. I'm missing, if there was a question here, Tom, sorry. Unless it was we're talking about taxes. Yes, if you're driving, don't do voice to text. Be careful. There we go. And then there was a super chat from Jace. Appreciate and respect you. Thanks for being real. Thank you. I appreciate that very much. And I'm making sure I'm not missing a question here. I always want to try to catch all of those. Thank you very much for that. Is appreciated. And thank you for the question, Majid. I appreciate it. That was actually a good one to bring up. That's probably something I should do a video on. Stephen, howdy. Wandering Doc, let's say you always keep at least 100,000 in cash reserves. Lumberjack Landlord and Michael Zuber's reserves is 50,000, mine is 50,000. So I'm wondering how big your portfolio needs to be for 100,000 to be the number that you chose. Any reason to take out a home equity line of credit at any interest rate on that at that point? So the home equity line of credit always comes down to, again, what's the purpose of the money? Is the return going to justify the debt on the asset that the HELOC is on or RELOC is on, and going to make the return on the asset that you're purchasing? So that's where I always start with that. I don't want more than 50,000 in a reserve, because anything more than that should be going into an account that's going to purchase something that makes me more money. Yeah, so I don't know that having a bunch of money in the bank would make me take out a home equity line of credit or stop me from taking out a home equity line of credit. I would reduce the amount of reserves, take at least 50. Well, pick what decides on your portfolio makes sense for reserves. When I had up to 7 units, I didn't want more than 10,000 in reserves. I wanted more money growing my portfolio faster. When I got above 7, I thought things can go wrong in a chain, so I wanted 30,000, and then I kept it there for years until I retired. When I retired, I raised it to 50. And in all of that, I have not taken out a home equity line of credit. So are you trying to grow unit count or financial freedom? Right? You can get financial freedom from unit count, but if the goal is growth for growth, it's going to be harder to reach financial freedom. Sheena. Okay, I read that question because it was in from the super chat. Thank you. And love it when my chat moves. Wondering Doc, for example, if you're holding cash, your cost of capital is 0%. So why take out a home equity line of credit? And your cost of capital, if you're holding cash, is inflation, right? We're at 7, 8, we were at 9% inflation. So if you have money in the bank, your cost of that capital is inflation. If you take out a home equity line of credit, Your nominal cost is what inflation plus the percentage rate of the loan. So if you have a home money in the bank, the purpose of it should be what do I need for reserves? Everything above that should be put to work so that you don't have the cost of holding capital of inflation. The Yoder, Lumberjack. I'm looking to do a 1031 within the next year. Thank you for sharing. Nice. Yes, he's got some great information. He's actually done that a few times. So, Jones O, howdy. I'm trying to see, get to the questions here. We just came up on an hour, so my voice lasts that long before I drink some water. My daughter made me super proud when she was like 14. Thank you, Craig, for this. When she taught me how to do a shot without making a face. And, you know, when you're not drinking water. 14. She came, she said, take the alcohol, put it in your mouth, and you don't swallow for a few seconds. Because then your throat will adjust to what you're drinking, and then you drink it, and you won't make the face. And I was like, you're 14. Brilliant. It's exactly what I want you to know. Turned into an amazing woman, though. Combined loan to value. Thank you, Chester. Jay, howdy. Do you know if Zuber will lower the price of his course? I thank you for your weekly question. I will have to check. I'll actually ask him. I say this guy Jay keeps asking. Your extremely underpriced course, are you going to underprice it more? I'll probably word it like that. Sean, howdy. Would you ask for the bank statements as well as letter of estoppel if you're going under contract for a fourplex? I have asked for proof of deposit. To me, that's more important than estoppel, but I mean, you want to get both if you can. So proof of payment, I have asked for that. I haven't ran into too much trouble with that. It depends on how they were running their business, though. Sometimes you're going to get a screenshot of Venmo and PayPal and Cash App, or a picture of checks. So yeah, I would want as much proof of that as possible. Still going into it with, do I have the reserves to handle issues with these tenants? There's probably a reason why the owner is selling, right? So make sure you have the reserves to handle that. Don't trust anything that's in the lease. Don't trust anything that the seller or agent says. Look at area average rents. If you had to rent about 10% below that, would this still get the yield you were looking for? Do you have the reserves to handle a couple of tenant issues that could take a couple of months to resolve? Like that's how I look at that, more so than whatever information they provide me with, because at best that is maybe you can go to court and say they lied to me if it isn't true. It isn't going to protect you in those months when you're having the issues. Area average rents a little below that, and the reserves to handle some months to stabilize is what's going to make you handle that. Success is Adrian. The combined loan to value, thank you. So for a rental, a HELOC, first mortgage plus HELOC line loan must be 70% or less. Thank you. Lumberjack line. If you can't afford Zuber's course, you can't afford real estate. I know nobody wants to hear this. If you can't afford a down payment, you probably can't afford the real estate. So if you have to borrow the money, if you have to creatively do something to get the money for the down payment, I said this earlier, you're not magically going to figure out how to manage money because you have a cash flowing rental. You're going to have something like Cody did earlier, not Cody and Christian, other Cody with a K. We had 3 evictions in the first 6 months. Right? If you don't know how to save to get to the point to do that, you're not just going to start saving once you have money. That's backwards thinking. Laura, howdy. Hope you're doing well. Living in Dave to Lumberjack. I can't wait for your course and to tell you why I nicknamed my duplex the Funhouse. Exactly. I can't wait for the course too. I think I get to be a part of the boot camps. That'll be great. Tom Kine, the cost of Zuber's course was the cash flow on my first rental. On the first months, right? Yeah, first months of your first rental. That seems about right. I like it. Nice. And you messed up his name, which is great because I did that on BiggerPockets. I called him Gruber. I hate my memory. But Mike has a sense of humor and he laughed it off. At least to me. I don't know what he said when I wasn't on the call. Dividend Dave, great approach, Tom. You don't pay for Zuber's course, your tenants do. Nice. That's the way I look at property taxes. I have never paid any property taxes. My tenants pay a lot. Joe, howdy. Anytime can be a good time for a HELOC. Just got to use it wisely and for the right purpose. Exactly. It isn't the interest rates. It isn't the price of properties. It's what's the purpose of the money? Are you going to use it to create good debt or bad debt? Bad debt, always no. Good debt, okay, now let's look at the good debt. Can you pay it off before the rates adjust? Right, there's a couple of things to look at there. So, but that could be at any point in time. It could be when interest rates are 10 or 20%, it doesn't matter. Does the asset produce enough to justify the debt, whatever the rate is? Lauren, I made it tonight after all. Howdy from Tacoma. Nice. Are you going to be at Christian and Cody's event this weekend? Wandering Doc, Dave starting an OnlyFans called Only Homes business in one side of the duplex. Exactly. Anybody watch The Rookie? This is a great episode. The last one that aired on his girlfriend has a rental. Nice old couple. Haven't paid the rent in a few months, and she just doesn't want to be mean. Of course, they're in LA where there's an eviction moratorium, but they were using it for shoots. That's great. It was a great episode. John, I bought Lumberjack Landlord's course out of reserves, or rather my tenants, exactly, your tenants bought the course. And you can write it education off. Lumberjack Landlord, this is a great, I want to see Jay's reply. I will buy you Zuber's course if you pay me half your rent profit for the first 2 years. I think that's a great deal. Chris, howdy. New to the group, all night onto the group. Nice. So this is a group of different people with different strategies. You have Lumberjack Landlord who has over 130 rentals. He self-manages. He's got about 600,000 in rehabs going on right now. His course is what you do once you're a landlord. It literally is something like, oh shit, I'm a landlord, now what, right? Like, what do you do after that? Millennial Mike, house hacks like I do. I still house hack, even though I'm financially free and retired. I actually kind of like getting paid where I live. He house hacks in a high cost of living area, but he invests out of state. So he really has a good strategy for if you're in an area where the properties just don't cash flow or it takes too long to save the down payments because of the price. There's another way to do it. Zuber from One Rental at a Time has a course, has books. He's got decades of experience like the Lumberjack Landlord does, invested through the 2008 housing crash. So here's something to take away, Chris, if you're new to the group. If there's someone like me who started investing after the 2008 housing crash. So in 2008, I got laid off from a police department because, when we're having a recession, there is no more crime and we don't need cops anymore. So I got laid off, started working at a truck driving school, making like $17 an hour, rented my house out for 2 years, so that I could live in an apartment, save money, buy a duplex to start house hacking. So my story kind of starts around 2010, 2011, right? The bottom of the market where I start buying properties as the prices go up. And every single year since 2011, some doofus has been on the internet, on the news saying, don't buy, there's going to be a crash because in 2013, prices went above 2008. 2014, there's going to be a silver tsunami. All of these boomers were going to start retiring and there's going to be a flood on the thing. On 2018, the interest rates went above 6%. 2020, there's a pandemic. We have an eviction moratorium. Like every single year, there's a reason not to buy. So I bought all the way up. You shouldn't listen to me. I could have made huge mistakes and would have been fine because we were in an uptrending market, right? So the reason I'm confident that I can share my information and people can actually learn from it is because what I did is I found guys like Lumberjack Landlord and Zuber, who've been investing for over 2 decades, who had their, this is what stocks did to them story, and that's why I don't invest in stocks too. But they've done some simple things like, and this is something that actually Matt is doing now that he learned in 2008 he was renting to construction. Like construction was booming 2006, 7, and 8. And then all of a sudden construction gets hit and he goes from like 8 or 9 tenants paying to 1 paying, right? He's almost bankrupt over it. So from that, I was like, oh, so a diversified tenant base might make me more likely to survive the next housing crash because it's probably going to happen eventually, right? So I go 1/3 military, 1/3 Section 8, 1/3 working or retired. I learned that from watching guys that were investing from before then. So I'm not saying don't watch my content. I'm saying my content might have more value than it would if I was just sharing my experience, because my experience is you can buy anything and a couple of years later, you're going to have hundreds of thousands of dollars in value there because it just happens, right? That might not happen this year. Probably not going to happen this year. A couple of people are calling for prices to come down over the next couple of years. So your appreciation isn't going to happen like it was. But I diversify my tenant base so I can handle a pandemic, stock market crash, prolonged government shutdown. I keep my properties at least 10 miles apart, so I'm pulling tenants from different sources. So a base or a port or a college or something can close down, and I don't lose all my tenants all at once. I'm building a portfolio, planning on really bad things to happen, and laughing every day that it doesn't. So welcome to the group. Hope you enjoy it. A lot of great info being passed around here. And sometimes people in the comments will actually answer something with sometimes a better, more articulate answer than I'm going to come up with. And I do my live streams every Tuesday at 4 p.m. Pacific. Lumberjack Landlord does his on Sundays at 8:30 Pacific. So that's 11:30 Eastern because he's in Siberia or by Boston, that area where it's cold. Millennial Mike, we're trying to twist his arm into doing his live streams at certain times. I have actually a strategy to get him into that. So nice. Having a couple of people saying welcome to you, Kris. That's awesome. Fuji, howdy, from Minneapolis. That sounds like a real place, like Metropolis, right? All-nighter hider. Kris is a local buddy from high school. Awesome. We both learning real estate investing more thoroughly. Nice. Kris, I actually met All-nighter hider at Zuber's Fresno event. That was really cool. REI Stoners, how's it going? Howdy. Chase, thank you. Awesome. Thank you. And this is where Rob said, saving for down payment suck. Those first 5 years, they suck. Like most of the people that we interact with in this kind of community don't want to live those first 5 years. But almost everybody wants to live the next 5 years. Like there were 5 years where, I never took a vacation until 2018. But I didn't just go, yeah, I'm gonna take a 3-day weekend and go to Vegas. I was like, no, I'm gonna take a month and go to Colombia. And then I'm gonna take a month and go to Thailand. And then I'm gonna take a month and just drive around the country. And then 6 months ago, I said, I'm gonna take a month, every month, forever, forever, and never work again. These are the 5 years that people want to live, and that's what I'm trying to share. We kind of have to go through, and it might be 2 years. You might be making more money, have less bad debt, have YouTube University. It took me 5 years to get kind of financially stable because my first year sucked so bad. Brian, howdy. Yes, I should keep my hats in here. Julie, the crash is over. That was actually fun videos to make on Zubers. I've seen a couple this week on there, and we did one today as well. Don't know if it came out yet. I have to check. I always try to go through and answer all the comments on there. A lot of people hate that we haven't seen a crash in prices. And we can say something like the crash is over because we did see a crash in transactions. We had over 6 million transactions kind of consistently done for a few years, and all of a sudden we barely break 4 million. Rates go up, prices haven't dropped. And people were screaming, oh, you guys are all wrong. There's going to be a crash in prices for years. People have been screaming that we're wrong, that there's a crash coming. And even if there is, you still don't wait to buy. It doesn't make sense to wait to buy. The largest 12-month period in any market ever has been an 8.9% drop market-wide. The cost of rent for that period of time, the lost principal pay down, the lost tax benefits, doesn't make sense to wait for a crash. So even if there's a crash coming, still don't think that's something that people should be watching. Fuji, I have 60,000 to invest, just all on crypto. Just go. With these rates is only one part of the equation. Wouldn't it be better to buy bonds rather than real estate and provide higher returns than rentals with no hassle? So if you want no hassle, yes, there's a lot of ways to invest outside of real estate. So my channel heavily seems to go to real estate because it's how I reach financial freedom. But Fuji, there are 3 main paths. There are hundreds of paths, but there are 3 main ones. The first one is to start and grow a business with the goal of getting it to a point where it's large enough for someone else runs the day-to-day and you reach financial freedom. The second way is to invest in stocks or bonds or crypto or something where you can have a dividend investment or a well-diversified stock portfolio, or you go into bonds for less risk, maybe a little less reward, whatever, less hassle. And then there's real estate. So with these rates, What's happening with stocks? It doesn't matter how many stocks you buy if they keep going down 20, 30, 40%, right? That's not a great investment. Everybody go, well, historically 10% over X number of years. But if you miss the like top 10 trading days, you've lost money every year for the last 100 years. So you have to have the best dates. So don't try to time the market. If you're buying real estate and you can handle the hassle, right? I put REITs, real estate investment trust, in the stock category. You don't have the control, you don't have all the benefits. And what I don't like about dividend stocks, because I'm not a stock guy, is that when dividends are paid out, the stock value drops about the amount of money to pay out. So you're really not ahead. You're just getting that dividend. So that is a path for some people, if it makes sense. If that's what you're excited about, do that. The reason I'm excited about this is I can house hack real estate. I can't house hack stocks. Leverage on stocks can get called when you use margin. Leverage on crypto can create a fiasco of tens of billions of dollars and put Sam in prison, right? Leverage on businesses I have one failed because my wife at the time emptied taxes and wages account, and the other one I mismanaged, so you can lose money there too. But in real estate, we take out debt, fixed rate debt, not the Dave Ramsey 90-day callable loans where it can blow up in your face. But I mean, you fire a mortgage that's going to last for 30 years, that debt becomes the asset. Inflation makes the debt easier to pay off in the future. It's why the Fed wants a 2 to 3% inflation rate, so that the government can pay off their debt easier in the future. It benefits people with assets for inflation to happen. I can house hack it. I have control. I can diversify it easier than stocks. What stock are you going to buy right now that's going to go up, guaranteed going to go up in the next 10 years? We can all look back, perfect hindsight, and go, yep, if you bought Amazon in 2007 and you put $1,000 into it right now, you'd have $4.8 million in value in Amazon stock. Would you have sold at some point? Would you have bailed at one of the splits? You don't know. But name the 10-year period in the history of our country where real estate wasn't worth more in 10 years in the future. 2008 to 2013, prices were higher. It's not a 10-year period. So you can have troughs and valleys. There is some hassle with real estate. It takes me about 2 hours a month to manage my 16 units. I believe it would take me more stress to manage a portfolio of stocks and bonds, to wonder what's happening with interest rates and the yield and the markets, and watching, I've talked about this the other day, that the most effective investment portfolios belonged to people who died, because no touchy, right? The second most effective investment portfolios belonged to people who forgot they had them. And then in 2013, there was a study with a cat named Orlando, who they watch the cat walk on the keyboard and they invest in what the cat walked on. And that outperformed most managed accounts. So yes, bonds might be a more secure, you know what you're going to get, but it's going to be taxed. Right? You're locking your money up. So then if you found the real estate deal of a lifetime, you're going to pay the penalties of whatever it takes to cancel the bond, buy the bond back, or sell the bond. Invest in what excites you. You're more likely to stick to a plan when some things kick you in the face, which they're going to, and no matter what you invest in. But if you want no hassle, real estate might not be the way. Buying a property is quite a bit of commitment. I mean, it didn't take as much commitment as it did to become a Pastafarian minister and marry people in a pirate suit. Like, for that, I literally had to go to a website and click yes. That was a massive amount of commitment. But to make an offer, to negotiate with a seller, to get it under contract, to learn the market, to figure out what's a good deal to even make offers on, to watch interest rates and prices and rents to get the yield, which is the number we do care about, not the prices, rates, or rents, but altogether what the yield is going to be, to then go and look at the property and say, does this property have things that's going to help me limit tenant turnover, because that's expensive? Like, the amount of learning and education you need to have to buy the real estate, to then manage the property manager or manage the tenants, isn't passive. The IRS calls it passive income, so you get the passive income benefits, but it's not really passive. Like I said, it takes me 2 hours, and that's an average. Most months are 30 minutes for me to manage my 16 units, but every now and then I have a 4 or a 5 hour month, so it averages out to 2 hours a month year round to do this. It's not passive, but it excites me, right? My fourplex, I call this place the Rocinante. Let me know if you know what that's from, and it's not from The Expanse, but they use the name there too. But Don Quixote had a horse or mule or whatever it was. I forget the myth or the story, but it was his little workhorse. This fourplex kicks off money every month every month with me living here. It's profiting about $2,500 a month right now. And appreciating. And the tenants are paying off the debt. And I have never paid a penny in rental income tax because of depreciation and write-offs and benefits that bonds and stocks just don't have. So it's a great question. That's really unique to the individual. There is no one right way to reach financial freedom. There is a one right way for you. That might be bonds. I have currently $0 invested in real estate. Right? Over the period of 12 years, I'm buying the properties. I put out about $320,000 from my income in down payments and about $300,000 from cash flow from the property. So out of my own earned income, $320,000. Right now, there's about $500,000 that I'm going to use on the next investment. So that money's paid me back all the money I've invested in real estate. But out of my own pocket to get the portfolio that's producing over $200,000 a year in profit right now, I invested $320,000. If you put $320,000 into bonds, will you have $203,000 worth of profit next year? Right? The return is astronomically better in real estate because a bond is going to pay you 4 to 10% or whatever you can do. You might be able to time the sale throughout the year, watching the 10-year versus the 30-year, all these things that I don't understand and don't want to. So you might get a better return. But every single one of my rentals gets around a 10% return first year, right? Sounds great. I would take an 8 in some, as the market goes down, I want to get better than average, right? So average in my area right now might be 8% is a little better. So my next deal might be only an 8% deal, right? 100% of my properties are better than a 20% return by year 3. Rents go up, mortgages basically stay the same. The tax benefits continue. Once you stabilize the property, there is a reason why real estate produces the most number of millionaires, and 90% of millionaires are invested in real estate. Like there's a reason why that's a thing. So I'm not saying one's better than the other. I'm saying for me, there's a long list of reasons why I chose real estate and not another asset class. But that doesn't mean you can't choose crypto or stocks or a business or something that you take the time to learn and master that. Once you become wealthy, now you might diversify and put some money in other asset classes, but don't do that in the beginning. Don't put some in real estate, some in stocks, some in crypto, some in growing a business. Like focus on one thing and master it until you reach freedom. Then protect that. Lane, howdy. Shout out Spokane. Exactly. Spokane's great. We almost put a campus there. I forget why we didn't. We were looking at Vancouver or Spokane when I were in the truck driving school. Dividend Dave, Rob, I'm right there with you. You got to start thinking creative, like Cody and Christian, and Pace more be creative. Exactly. Laura, I took out a home equity line of credit on my paid off home to help my son with the down payment on his duplex, a great generational wealth building strategy. If it's something you're comfortable with. It was $1.99 fixed for 9 months, so fixed rate interest rate for 9 months, 1.99%. He paid me back in 12 months. It was 2.99 at the end of 12 months, right? So great job helping set somebody else up and getting them on the property ladder. That is a good use of that. I'm saying, is it a good time to buy a HELOC or not? Doesn't depend on the rates. Depends on what's the use of the money. Can you pay it off before the rate adjusts? Like all of those are the questions that you go through. My brother reached financial freedom only using home equity lines of credit. Never used a mortgage, right? He purchased a property like in the 90s. Might have been it was either late 80s or early 90s. Cash, right? He ran a business, had the cash, purchased a property, took out a home equity line of credit, and would buy a mobile home that was falling apart, kind of in the middle of nowhere. Then he's a craftsman, like he would go in, and since mobile homes are all kind of basically the same, maybe not layout, but the same structural kind of things happen, he would go in and do all drywall, all rounded corners, and really just make them a nice rental. Pay off the HELOC, rinse and repeat, got to 10. He actually got to 10 twice because yay, divorce. But it's probably not, he doesn't laugh when he talks about it. It's really weird. Why doesn't he laugh? I'll have to ask him on camera soon. I'm gonna burn in hell. But 10 paid off rentals, and then he retired at 50. He's been retired for like 8 years now, and he's just traveled and he's got Sea-Doos and quads and side-by-sides and an RV, and he just lives the life that everybody would want. But nobody, not even me, is going to want to do the buy a property cash, which I didn't have the ability to do. run a business. He was running a tree service and do all the work to almost all the work to the rentals himself to put them in place. Like myself and everyone we knew thought he was insane. He was doing, 10 to 15 hours a day on the tree service, which tree work sucks. And then he would do 5 or more hours every day on a rental to get it going, right? And then one day he was like, yeah, I got 10, they're all paid off, shut down the business, never have to work. He was 50 and he was like, yep, I'm just done forever. And everybody's like, oh, he flipped the switch. He wasn't crazy forever. He was crazy for now, to now live the life that most people can't. And it was a great example to get me motivated to do this too. Beto, howdy. I did the binder strategy on a tenant. She only raised it $50 per month. Rent is $1,450 and market rent is $1,800, $2,000. How should I counter? Thanks. So she made a suggestion of 50. I've had this happen too. Remember, this is a conversation. So how are you doing it? Was it in person? Was it through email? Was it through text? Did you provide enough examples showing that the rent is around $1,800? And you could say, because I've done the same thing. I forget what the numbers were, but the rent was at a point, the area average was, $500 or $600 higher, and they made a suggestion of like 100 or 150. And I said, oh, that does, because the question is, what do you think is fair? That does sound fair to you, right? Remember, a compromise is when both sides lose. The best thing that would happen for me is if we don't renew your lease, you move out, I get $18,000 or $1,800 a month. I have to do some rehab, I don't want to kick you out of your house, but at $50 a month, it doesn't make sense for me to have you here. Do you think that sounds fair to both sides? It's a ongoing conversation. And then that one time the tenant did come back with more. I've had friends where the tenant suggested an amount and both of them suggested lower than what the tenant did. So it can go both ways. Remember, it's a conversation. Sometimes, not always, but sometimes the best result is a tenant turnover. So they raised it 50 to 1450. And the market rent is 18. So if they were at 1450, they raised it to 1500. So you're still $300 off. So if the tenant moves out and you spend $5,000 on flooring and paint and the month with no income, right? So you're gonna be out $5,000 for a $300 a month increase, because now area average rents are 18. You're 18 to 2,000. Sorry, so it could even be more. I'm going on the low end. Say $300 a month. The first year that tenant's out, you're gonna make $3,600 on $5,000. That is a 72% return on your money. Matt, correct me if I'm wrong, because I'm not the math guy. 72% return on the first year. That tenant turnover is the best thing that ever happened to you. Maybe you had kids. They're great. I wonder what that's like to have great kids. I'll never know. Luckily, they don't watch my long form content either. My kids are awesome. But and that was at 18. If you get to 2,000 because you did a nice, new stuff in there, and you followed Lumberjack Landlord's simple strategies on. He's got like some videos in his course on here's the 5 things you do that actually get you the best new rent, which I can't wait to see because I like to learn from him. Your return might even be more than that. So yes, the binder strategy is a conversation. If a tenant said, well, my rent's $1,450, you're showing me the area average is 18 or 2,000, I think I should pay $1,000. That would be fair. Yep. I'm not renewing the lease. Have a nice life, right? You don't have to renew. You might have to know the timeline in your area, what you cannot renew for. Are you going to do a rehab? What amount of notice you have to give to do the rehab? Do you have rent control first? Consider that, because even the binder strategy can run into problems if you're in rent control area. Make sure rent control applies to you if you're in an area with rent control. Some areas it has rent control, but it doesn't apply to single family house, or it doesn't apply to small multifamily if you're house act, or it doesn't apply to a portfolio that is self-managed by a sole proprietor who owns less than a certain number of units. And then I don't know what your area is, or even if it has that. So this is where we say real estate is local. That's how I would handle that. So even a $50 increase that doesn't get you anywhere close to area market rents is not something you have to agree to. Let me know how that conversation goes now that you have what my input was. Let me know. Rob, I'm in San Diego. You mentioned creative in my market, and the laughter begins. The 2 guys, Christian and Cody, that they live in San Diego, found a way to invest at a distance. So I'm supposed to have them on the channel here pretty soon. looking forward to that too. Millennial Mike, I asked a real question for once. Scroll down. A real question. Thank you. And I appreciate the super chat. Looking forward to Saturday. Hopefully, I need to reach out to Christian and Cody and see what the day is looking like. I want to rent a unit out by the room. I have two 20-year-olds, each with low credit, but good work history and proof of income. Credit scores of 590. Part of the low credit, I think, is age. What would Dion do? Dion would not rent to somebody with, I have no tenants that I placed with less than a 700 credit score. I have some inherited tenants, which is a term no one likes, but what pre-existing tenants, but that actually sounds weird too. Where I purchased a property and there was somebody living there and I don't even know what their credit score is, so it could be anything. Remember, you don't get to vet them, so that's why we don't do the binder for 2 months after closing on a property. Co-signer, know your local laws. Are you allowed to do a larger deposit? What is the demand on those rooms? Do they know each other? If you're going to rent by the room. Have you watched some of Todd Baldwin's stuff, Mike, on how to handle common areas, how to do your leases? Like he's got some good info on that. Low credit score is usually a deal breaker for me. I don't care if somebody makes $1 million a month. They're not renting my place if their credit score is below 700. Somebody who has worked hard to get their credit score up will protect it. I know people making six figures that are late on every bill, and I don't want them on my properties. So I know that there's a lot of people that go, I want to multiply. I've never even asked what someone makes. I ask where they work so that I can verify employment to make sure that they're not lying to me about some things like, and if somebody gives you their information, I use Hemlane, but if you use Apartments or Zillow or whatever to get somebody to capture their info, never verify employment with the name and phone number that they provide. Find out the name of the company that they work at, Google it, call and ask for HR, verify that way because it's very easy to fake employment. Printed pay stubs are very easy to fake. Credit score, not so easy to fake. You can work the system and they can screw you over. It's still possible, but I'm on a decade without a late or missing payment. So, and no evictions, because that's the other thing is I'll never let somebody with an eviction in either. So in this one, and you did, Laura, you knew it was Don Quixote. Good job. Thank you. The Rocinante. So can you have a cosigner? Here you can do a larger deposit that still can turn into a nightmare. What's the demand, right? So before somebody starts talking about, I want to rent my property out, this person doesn't have the income that I want. If that person wants income, doesn't have the work history that they want, doesn't have the marital status, which you're not allowed to use, right? You can't discriminate, but doesn't have something that you want to use. Why are you bending your rules? Did you have it listed for weeks at or below area market rents, and you have no interest? And you're like, okay, I can no longer carry this. This person's willing to pay. I'll take it. So I think anytime you lower your standards, you're going to run into problems. So I wouldn't. I'm happy with a cosigner. I know Matt says, I don't ever want to talk to mom, but I don't care. You're with your background, and I know Matt could handle this too, but Mike, with your law enforcement de-escalation skills, if it's your house act one, I wouldn't do it. I would have a cosigner. If it's your property management, find out what their policy is. I will do cosigner with better credit. Have somebody on the hook who has a credit score to protect. That's what I would do. So great question. And thank you. Peter, I have a room to build an ADU in the back of my primary residence. What would be pros and cons of doing this? I know I have to look at costs, labor, permits, and rental potential as a start. So those are some good starts. What's the cost of building it? The permits. How is your municipality with that? Talk to contractors and find out, is it a 2-month project or is it 2.5 years like Zuber is with California and in his area, and he hasn't even done yet. It's like $7,000 or $9,000 out on built plans and stuff and doesn't even have anything started. And then they go, well, yeah, and you also need to do $16,000 for solar panels, which kills his ROI. Watch that ADU guy. Derek's got some great information on sometimes. Write this down. Size matters. Sometimes you want to build an ADU that's as large as possible because you think the more space, the more stuff, the less likely for turnover. But the larger expense of building the larger ADU isn't justified by the amount of rent that you're going to get. So sometimes the better ROI is that 2-bedroom or 1-bedroom, depending on your area and what the rents are. So don't think that there's just one way to do it. Build the smallest or the largest. Find the one that has the best yield in your market and build that. But that's the thing for me. How amenable is your city? And don't listen to your city on what they say, because they will lie. Will literally say they will lie. Some friends that went in, spent $7,000 on the build for a duplex because the city said, yeah, we absolutely want small multifamily in the area. You're zoned for it. We encourage you to do it. He got the permits, and then they said, yeah, we changed our mind. It has to be a single family. So don't worry about the $7,000 you spent on that. Just throw it away for a year. And then they came back and said, oh, no, you could totally do a duplex. Let's do that. Listen to the contractors who've worked with the city. That's who's going to know if the city is easy to work with or if they're a nightmare, because that's also a factor, not just the yield. I know it comes down to math. We start with math. When we look at a property, we go, is this going to get the yield I'm going to want? Right. Okay. Then does it have the elements that's going to help me limit tenant turnover? So then we do the deeper dive. It starts with math. We go in. What's going to be the best thing for you? Is it going to be to buy a property or buy a property that has an ADU, or is it to build this ADU? Then it's what size of ADU. So we start with math. Can we get the yield we want? Then we go, how's the city to work with? What's the supply chain issues currently going on? How are they going to impact my timeline? Watch Uneducated Economist to find out what's going on with wood, to figure out now might be the time. He's talking about wood prices coming down, and that really impacts the industry. I know that my first truck driving job for 6 months, before somebody committed suicide by driving head on into my logging truck, which was awesome. I was delivering logs, and board foot per log on delivering it could tell you whether you were going to drive 30 minutes to a mill or 2 hours to a mill, because you can make way more money based on where the wood was going and what it was being used for. So watch Uneducated Economist, because his industry knowledge on wood is going to help you know what's going to happen with builds. So there's a lot to look at there. It's not a, yeah, just do it, or no, I wouldn't do it. It's does it make sense for you in your current situation? And do you have a buck for your money? Is there a better use of capital, to steal the lumberjack landlord's phrase? Is there a better use of capital for your money than building that ADU? Maybe not. Maybe your city's great to work with. Maybe the contractor's right there, and you don't have any supply chain issues, and it's the best way to go with the best yield. But until you kind of go through that chain of logic, until you've done that, you won't know what's the best course. Great question. Thank you. Paula, howdy. And All Nighter Hider is in that area too. Jay, how many properties and how long did it take you to be financially independent? So good way to phrase it. Financial independence and financial freedom are different things. Let me know in the comments if somebody wants that defined. But financial independence happened for me at about the 8-year mark. It was 7 properties. One of them was paid off, and I would not pay a property off now. I got to 4 mortgages. And at the time, lenders were letting you go to 4, and I was uneducated. I didn't know about DSCR lending. I didn't know about asset-based. I didn't really look into seller finance, like all these other options to go if you go above 10 in your name now. But I got to 4. Bank said 4 was the limit, so I focused and paid off my single-family house. And at that point, the cash flow from 4 properties, 7 units, so 1 single-family and 3 duplexes, while I was house hacking one of the duplexes, the pure cash flow profit after setting aside for repairs, maintenance, and vacancy, after paying principal, interest, taxes, and insurance, was at $2,700 a month. And when I was a police officer, where I was raising 3 kids and had a mortgage and wasn't house hacking, my take home was $1,300 every 2 weeks, so about $2,600 a month. So I was making more on passive income from real estate than I was as a police officer. So to me, that was financial independence. Work was kind of optional. I wouldn't retire. Like BiggerPockets, David Green nails this. You do not retire on cash flow. If your cash flow meets your freedom number, that's not when you retire. You might change jobs. How much you make at your work might become less relevant. Start looking for that job that you enjoy more. I didn't retire until my cash flow hit the 4x rule. When I had 4 times the amount of my freedom number coming in every month that I didn't have to sell my life for 1 hour at a time, I actually started to feel stupid going to work. Like wake up in the morning, put the clown nose on, and go make money that I don't need, right? So then I finally retired. But it wasn't financial independence. Right? Financial freedom is when you start not looking at price tags. Financial independence work is kind of optional. Financial freedom, instead of going and buying a Lamborghini, you pick how many you want and which colors you think are going to look the best in your yard. right? So the financial freedom happened for me around the 11th year. So independence at 8 years, and I could have retired, but I worked 4 more until 12 years. And at 12 years, I'm definitely into financial freedom, and it feels weird. And the numbers of dollars in the bank account, even when I do things like, oh, I'm going to go to Vegas, I'm going to do all the shows, I'm going to Uber everywhere, I'm going to spend all the money, and I'm going to stay right on the strip. Whatever I was doing, I come home and it's like, oh, there's $15,000 in my account that wasn't there when I left. Like, I have to figure out what to do with this now. And so now it's like $500,000 that I need to put to work somewhere. That didn't happen. That didn't exist in my world the first 5 or 7 or 8 years of investing. But it becomes a thing. And I'm trying to drag as many of you kicking and screaming to that point. Doesn't take hundreds of units. Doesn't take a whole bunch of paid off properties. Like my brother has really good cash flow with 10 paid off properties. You can get hundreds of units. You can do what Zuber and the Lumberjack are doing and have hundreds of units. And then literally have cash flow in the tens of thousands per month beyond what it takes. I mean, tens of thousands. I think Lumberjack's goal is 200,000 a month or something, and then he might retire. So, no matter where you're at in life, there is somebody extremely higher than you in the income and it's extremely lower in you in the income. But that's how long it took me, Jay. About 8 years. REI Stoners to Rob. We lived in Monterey Bay and decided to move to Washington where the market fit is better. And Washington's amazing. It's one of the only places in the country where everything's not trying to kill you. No hurricanes, no poisonous spiders, no poisonous snakes, no alligators. What else is it? We do have Mount Rainier that's probably going to take us all up. That's going to be quick though, so we don't have to worry about that. Howdy, Bill. To and Fro Global. Howdy. Howdy, Leah. What do you think about coin-operated laundry as normal machines and rentals? I'm thinking the tenants will feel nickel and dimed and not as home, having as always pay for doing laundry. That's a great question. So the other day I did a short. One of the contributing factors to the reason I have such low tenant turnover is because I look at the world a little different than most people. Most people will tell you, agents, investors will say, make sure your leases end in the summer because it's easier to find a tenant, because people don't want to move when it's cold. People don't want to relocate their kids when they're in school. And so you want your leases to end when it's easier to find a tenant. And I have the opposing theory. I have all my leases end between October and February. People don't want to move in the winter. They're more likely to renew the lease. So I have very low tenant turnover, 4 in a decade, right? One of them passed away. One of them inherited a house, one of them purchased a house, and one of them moved away. So like, I totally get why I had the turnover that I did, but I've never once had a tenant leave one of my rentals and rent another rental in the same area. It has not happened yet. One of those is because my leases are in the winter. The other things are, I want side-by-side units so I don't have tenants living above or below another, so I don't have noise complaints. I want, and you have to know your market, you have to know your area. I'm making a video on this, so it sounds a little scripted, but you have to know if you're in a retirement community or by a college, a single bedroom rental might do just fine, but I like to have 2 bedrooms with a garage because more space equals more stuff. I like to allow pets. People don't like to relocate a pet. So I'm, again, less likely to have turnover. I don't want to be next to a noisy club. I don't want to be next to a landing strip. I don't want to be next to a train. I don't want to be next to things that is going to make tenants leave. I want washer and dryer hookups in each unit, because anyone renting where they have shared laundry, coin operated laundry, or have to use a laundromat is just waiting for a rental to open, even if it costs more. I don't want that kind of tenant turnover. Sometimes tenant turnover is good. You can have better response than the binder and even get a bigger raise, right? And bigger increase in rent. But I try to have as little work as possible, so I don't want tenant turnover. So I am not against coin operated laundry, but it's one of the things that is a criteria that is on my no list. So no HOAs, no foreclosures, no short sales. I don't want over under units, right? But all of those are, if I found a deal and it had the right cash flow, the right yield, and it had a coin operated laundry, yeah, I'd probably take them out, put in regular laundry. I'd probably figure out how much is the cost of adding laundry to each unit. It could be like $5,000, maybe a little less, depending on your contractor. cost to acquire, if that included the cost of putting washer and dryers in each bedroom, is this still a good deal? It's like I've mentally gone through that checklist because I say, here's my list, right? I want more than 10 miles from my other properties, but I bought 2 that are 7 miles apart because the yield was right. And the other things were there, that several economic drivers, side-by-side units, a couple of, it doesn't have to have every single one of the things I listed off. That's my kind of wish list. If I can get most of those, then I'm probably going to make the offer. So that's my thought on coin operator. Wandering Doc, I agree. No one really needs more than 50,000 in reserves, but some people like to hold more cash than others in the order of 10 to 20% of net worth. It's a comfort thing. Yep, totally. So there's no one right way. What works right for you? I know people who keep way more than 100,000 in cash. And if they had any less, they would be very uncomfortable. Are you running a business where cash flow can be, 3 or 4 months, you're making 200,000-300,000 a month, and all of a sudden you have a negative 300,000 a month. You have to be able to handle that. So every situation is different. Brock, howdy. Thank you for hanging out. I appreciate it. Cody, howdy. Good to see you. I meant to ask you, Cody. You can text me if you want. I won't share the numbers, but are you okay talking a little bit about, like, if I talk about the size of your portfolio and the duration that it took to get there and stuff like that from our call, because you won the giveaway of the $5,000 hour. All-nighter hider, that is how I felt, and I avoided the machines for that reason. Yep, exactly. Wandering Doc, although you kind of convinced me, maybe it's better to put your money to work. The problem is I'm worried that I would buy a subpar deal in order to get rid of my cash. But yeah, don't buy a bad deal. I generally got to, the first duplex, it was 15,000 down. It was 5% on a $300,000 duplex, right? So I put my money to work, and then I was saving, 50 to 60 down payment on the next duplex or whatever came up. My intent in 2021 was to buy $1 million property. I started talking about, I want to buy $1 million property. I'm saving the down payment. And then a duplex popped up that was the right deal in the right place with the right yield, and I bought it. Since then, the money is piling up. And yeah, I have a lot more than $50,000 sitting in the bank that I would like to put to work, but I'm not just buying whatever comes up. Every month as that money grows, more options open, right? As you save $10,000, $20,000, $30,000, you start to have the option of house hacking, a loan down payment, owner occupied property where you can still have the reserves. You can move in, you can do these kind of things. You buy a duplex, maybe a triplex or fourplex with a FHA loan. So that's an option. And then you continue to save because you don't find the deal, and now you have 50, 60, 70,000 in the bank over the next couple of years. And you're like, oh, I could just use that money as a down payment, 20% down on a duplex. I don't have to owner occupy. I'm not going to have to house hack. That's an option. As my money continued to grow, where I want the 50,000 reserve, but there's all this money building. Now I have the portfolio in place, I have the systems, and I have the knowledge where I'm considering doing a BRRRR. And the biggest risk with a BRRRR is the financing. If you purchase at 3% interest rate and you have hard money at 4 or 5, and then you go to refinance out expecting 3% interest rate, and like what happened with Millennial Mike, all of a sudden it's 6 or 7%. He had the portfolio in place and he had the knowledge to actually be able to survive that and come out with a successful BRRRR. There's enough money in the account to do a BRRRR for me with my own money, not need to refinance, not care about what happens with interest rates. And then at some point, if it does make sense to refinance out, the ARV doesn't matter as much. The timeline doesn't matter as much. Those options didn't exist for me when I had just enough to do a down payment or borrow hard money and then be tied to a timeline and watching interest rates and seeing all those things that can happen with the BRRRR. So you're right, Wandering Doc. Yes, I wouldn't want to have more than your reserve sitting in the bank, but as that grows, you have different options open, and don't buy a subpar deal. Hunt for a great deal or a good deal. I know in the one rental at a time community, Zuber says a lot, go for a great deal. Don't compare year 10 or 12 to year 1. It took a lot of base hits for me to reach financial freedom. I'm trying to think if I've ever actually had a home run. I probably had 2 that I would call great deals, and 5 base hits. Financial freedom in less than 10 years. Wandering Doc, since 2017, except for one 1031, I have been exclusively investing passive syndications. And since there are almost no good deals the last 24 months, I just hold cash out. So it's growing. You say you like to deploy everything past reserves into new deals, but what if the new deals are not penciling? Keep saving, keep hunting. Something will pop up. Look at different asset classes now that you have that experience. A lot of the syndications for the last couple of years did really well because rents kept going up. Some of the syndications now are projecting continued rent increases like we saw for the last 2 years. That doesn't seem safe. Jay Smith, stop picking on me. We're not well off like you, but the way you get well off is by doing what Matt did. You're not well off yet, Jay. We'll get you there. Lauren, where is the Cody and Christian event? It is in a town called Union. It is about an hour west of the Narrows Bridge. So you know where the Narrows Bridge here at the 16. They own a 20 unit resort right next to the Bill Gates Resort or compound or whatever you want to call that place. And they're doing an event this weekend. You can book a cabin for 3 days, or you can get a hold of them. Email me, Lauren. I think you have my email. I'll put it in there, or text me. I forget. We've exchanged numbers, and I will get you in contact with Hannah, who is handling the event. I know Saturday is like an all-day event. I don't know what's going on the other days. I know that they have a plan though. All-Night Header agrees with me. Jay Smith, I think the point is that you can be well off. Many of the wealthy that I know started from nothing and not necessarily early in life. You can do it. Keep up. Good. Yep, exactly. Thank you, All-Night Header, for being motivational. So Jay, you watch my content. You have to be familiar with most of my story. I made it to 40 without ever having $1,000 in the bank. Was laid out from a police department, making $17 an hour, starting teaching people how to drive trucks as like a part-time night instructor to get my foot in the door. I ended up being demoted down to the president of the company. So it worked out over time. But that was a position I was starting in, and finding out about $313,000 in bad debt in my name I didn't know existed, which I was able to negotiate down to $89,000. Struggled to get those words out because it's such a fun time in my life. But I had to have the mindset like Matt of what is going to reach financial freedom. And it wasn't being rich. Being rich doesn't make you financially free. I know plenty of rich people that are living paycheck to paycheck. It's figuring out what is the purpose of money for you. Do you work to pay for things? Do you work to have a good credit score so you can have a big house and a big car and have people think you live the big life? Or do you think that the purpose of money, every penny that comes in, not you need 10,000 to invest, but the dollar that comes in next month, are you putting it somewhere so you can grow that, so you can invest in something that makes more money? That's what will make you wealthy. 77 Tadams. Howdy. All-Nighter Hider. I was just talking to Doc last night about going to conference and meetings, wealthy and successful people. Surround yourself with people that are doing what you want to do. I learned they're not any different from everyone else. They just took the right steps. Some of the wealthiest people I know seem to have the most, I don't want to say lack of life skills, but they pick the right life skills, right? There are some people who focus on fishing and they become a master at it, but it doesn't impact finances other than there's a cost to fishing unless they figure out a way to monetize it. There are other people that figure out how to grow, how to work their way up the corporate ladder, but they're not managing their money right. They're doing retirement accounts, stock investing, trying to pick stocks. They're doing all of these things that end up costing them money. But then there are other people that are like, yep, we bought an asset and it grew over time and we're just stupid wealthy. But it's not because they're doing anything better than everybody else. It's because they picked slow and steady and boring is sexy when it comes to money. Tadams, I'm in the first 5 years and it feels slow. Absolutely. I so agree. It was 2 years of saving over time, side hustle, to get to the point where I could buy the first duplex. And then it was 2 years of saving, house hacking with reduced expenses, overtime, side hustle, to get the down payment for the first investment duplex that I wasn't house hacking. So 4 years, I did two things. It feels like it takes forever. Jay, I think Lumberjack is motivating him. And he offered to pay for the course for you. Just sign a contract saying that you'll give him half of your rental profit for the first 2 years. I think it's actually a legitimate offer. Knowing Matt and having met him now, I'm pretty sure he would put that in writing. But we're down about 10% right now. Esther, howdy. What cash on cash percent or amount of monthly newbie investors? Make sure I'm not missing another part of that question. Okay, so what cash on cash percentage or amount of monthly for newbie investors? So I don't know that I would look at monthly cash on cash, or not cash on cash, but cash flow, right? The way to look at that is to study your local market to find out what is average. And here's what's average in our area. We're kind of more in Seattle and Moses Lake. I'm in around Tacoma. I look at 100 deals, 80 of them would lose money. Right? So I just kind of take them out of the equation. But I look at 20 that would kind of make money. If average was making 7 or 8%, I'm looking for the deals that make 10. Average right now seems 5 to 7%, so I'm looking for deals that make 8, right? So kind of watch currently what's going on in your market, because interest rates went up, prices haven't come down like we would need them to increase the yield. So in Matt's market, he was getting 25 and 30% yields on deals, right? So find out what is average and then beat it. That's what the new investor should do. Take the time to learn your market to figure out what an average yield is on the deals that would cash flow, because not all of them do. I wanted to buy single family houses when I first started, and I have not in a decade ever seen a single family house that would cash flow as a rental in my area. So I switched to small multifamily. Most of those don't cash flow. Sometimes people still buy them, so you'll wonder why, and they're not looking for cash flow. They could be a foreign investor looking for a place to park money that's not going to have the volatility of their currency. It could be somebody looking to 1031 exchange, and they're looking at the $10,000 or $20,000 they put into the first property 15 years ago, thinking, wow, I'm moving this 15,000, that's 400,000 in the down payment for this other property, so they're getting a yield that you wouldn't see, having to save up the money yourself. And it's just how they're looking at it. It's not that it's the way the numbers work. So study what is average in that area, and then look for better than that. And you don't have to beat it by much. If you look at your area, like you're in San Diego and you're Rob and you're going, wow, everything here sucks, everything would lose 2 or 3%, great deal would lose 3%. You're still consider house hacking and see if, because that reducing or eliminating your largest expense could be offset by even what some people would call an alligator while you live there. I still paid $300 a month to live in my first duplex. But maybe you start looking at another asset class. Maybe it's single family to small multifamily. Maybe it's house with ADU that a lot of people forget to look for. Maybe it's 2 hours out. Zuber lives in the Sacramento area and it doesn't work. So we went 2.5 hours out to Fresno. Maybe it's Gary, Indiana. Maybe it's another state. You look at a different market, right? And then look at what is average there, build your team, learn the market, find out what is normal and try to beat it. And then I see that Matt jumped in here. To Jay is a real offer. He'll put it in writing. Jay doesn't want to spend the upfront money. I will get a return over 2 years. Right. So it's totally valid. I don't think he's picking on you. Although if you know us, most of us are sarcastic. It's encouraging. And then I was at the Millennial Mike thing. Matthew, howdy, you made it. Appreciate the super chat there, Lumberjack. Let us know if Jay reaches out and puts that in writing. I think it would be great. David and Dave, thank you for coming in with a super chat. You're back now. Can I explain? I don't know when you left. I'd have to sum up the last amount of time that you were gone all at once. Sounds like a plan. You have to tell me when you left and I'll sum it up. I think we had our weekly ask if I think every time we hear somebody asking if Zuber's going to lower his course, he thinks about raising it. So I think that's why the price just actually went up. It went up, I think, a week ago. Wandering Doc, thank you. Dion was going to talk about divorce and whether he recommends marriage, but I feel like the topic is often swept underneath the rug. Cheers to that thought. I built up my active and passive real estate portfolio to be financially free after 8 years as well. Wandering Doc. If I would want children, which I do, I don't want to put myself at risk. I'm not trying to go back to work in my 40s or 50s. I want to get from the perspective of a real estate investor who has been married and divorced. So to raise kids, you have some expenses like healthcare to consider and education to consider. It might be easier to reach financial freedom and then have kids, but having kids was a really strong motivation to reach financial freedom. So I don't know that there's a right way to do that. I think that either way, pursuing financial freedom is still going to help you in both cases. Precision Property Management. Howdy. First live for me, super informative and relevant. Thank you. Appreciate that very much. Jay, Dion, thanks for your answer. If you were already in a property with 100,000 saved, what would your next move be? In my area, so again, I don't know your market, I don't know your area, don't know your goals. You're asking me, what would I do if I was in a property that had $100,000? I didn't get there. I got into the duplex and I got around 80,000 in the next 2 years because I was house hacking overtime, side hustles. Like, I talk about financial freedom not being about frugality or having a budget, right? I was frugal for a period of time, right? Frugal, not forever. That's my biggest, I think it's the biggest, top three at least, problem with the Choose FI community is the idea that you need to be frugal to be financially free. I agree, you do for a bit, for a while, right? But what financial freedom, if you had to be frugal in financial freedom, I would just work until I died and enjoy the weekends like 99% of the people did. Since I found a way to not have to be frugal in financial freedom, I would, in that case, so you have 100,000. I would look at a duplex in your area and do an investment property purchase. It's literally rinse and repeat what I did. Add the cash flow to the saving, continue to save over the next year or year and a half or however long it took to get the next 80 to 100,000 by the next duplex, and then the next 6 months, and then the next 4 months, and now it's like every couple of months you got to figure out what to do with the money. It sucks. I wish it was like, oh, you take the 100 and you do this magic thing and all of a sudden you have 7 rentals and you're free. It's not that way. You take the 100,000, you put it to work to get at least a 10% yield in my market. Maybe it's an 8%, maybe it's a 15% in yours. So that's another $10,000 coming in next year that you don't have to sell your life for, that you just add to the saving rate. Continue to save what you were to get to the 100,000 plus the 10,000 that's going to come from a 10% yield, or 15 or 8 or whatever the yield is in your market. Or if you house hack, it might even be more because you're reducing or eliminating your largest expense. Like that first duplex got about a 10% yield when I moved out, but it knocked $1,200 a month off of my living expenses, which was a lot more than what a 10% yield on the investment would have got me. Because I put in 28,000, or no, I had 28,000. Found 20,000, 15 for the down and then closing costs, immediate repairs. I put in about 20,000 to save $1,200 a month in rent. And that's significantly more than 10%. William Kraft, howdy. To Wandering Doc, maybe you should look at being a silent partner or a private money lender. Those are good options, given the right deal. And I would have partners, but have you met people? I actually almost recently partnered with Millennial Mike on something, so not all people suck. Red Berserker, howdy. Tom Kine, if you stopped after 8 units, what would your cash flow look like right now? So okay, I had 7, and the next step was adding 4, so I could do 7. The cash flow right now would look like, so it's 4 properties. If I did those, about $7,500 a month is what I would be getting off of those properties. Maybe a little more, around 8,000. So with just the 4 properties, with the 1 paid off, current rents based on the debt on those properties. I did refinance some in 2020 to a better rate than what I purchased them at, because I'm not stupid and I watch rates. So yeah, about $8,000 off those first 4 properties. So I don't think I had thought about that before. Yeah. So nice. Wandering Dog. Totally agree on syndications. Thank you. I passed on 94 deals that crossed my desk before I invest in one. Yep. So you get to do the work. There are great operators who have never lost a penny of investors' capital and have been around for 2 or 3 market cycles. Great. Believe it or not, there are great deals where we had 60% economic occupancy. They would still pay all of their bills. Awesome. And they're projecting 0% rent increase for 4 to 3 years. So you find the right operators, right syndications, you did the work. This is really good. Syndications didn't only do really well the last 2 years, they have done well the last 11, like most investors. Like I said, don't listen to my content if it was just me. Listen to my content that is impacted by studying from guys like Lumberjack Landlord and Millennial Mike and Zuber, who cumulatively, we all have years of experience when it comes to investing, right? Like Matt and Zuber going through the housing crash and knowing from what they learned, this is how I did my investing. I really like how Thatch Newen put it. Content creator here on YouTube and an investor up in Seattle. Great energy. I love watching his stuff. But Thatch said, when it comes to syndications, the bigger the name tied to the syndication, the lower the return. Just file that away. See what you can find. Okay, see if there's any questions here. I might be wrapping up here in a little bit. Scott Coleman, howdy. I jumped in at 9 o'clock Eastern. Do you use the HELOC right now, Dion? Okay, great. So at some point, please go back and just watch the first. I think I wrapped it up in 10 or 11 minutes. And I recorded it. I remembered to hit record and stop recording. So I'm going to have it as a separate video soon, but not today. On is it a good time to use a HELOC? And the thing to consider is it has nothing to do with interest rates. It has nothing to do with the amount of equity that you have. It has nothing to do with everything that a lot of people usually say, I'm going to do a HELOC because the first question is, so I'm not using a HELOC and I never have. I don't plan on it. I don't want to create debt on an existing asset, but I'm also not trying to grow a portfolio like Millennial Mike and Zuber and Matt are, where they're going to have, 2 of them have hundreds of units. I think Millennial Mike is going to have hundreds of units fairly quickly, right? I don't even know if I want 16. I might want less units with more cash flow. So I don't want to recycle capital. I recycled cash flow. But here's what you consider if you want to use a home equity line of credit. The first question is, what's the purpose of the money? Are you creating the debt to create more bad debt? You're going to take a trip. You're going to buy a car. You're going to do something, take a vacation, whatever it is. No, you don't use it. Are you going to create good debt where it's going to generate more debt, more income than it costs to have the debt? That's the first thing. What's the purpose of the money? The second thing is, can you pay it off before the rate adjusts? And I hear so many doofuses go, well, it's a fixed rate HELOC for 10 years or 5 years or whatever the thing is. It's fixed rate for a period of time. Can you pay it off in that amount of time? If you're taking out a home equity line of credit of $100,000, but it's going to take you 30 years to pay it back like a mortgage, you don't know what the rate's going to do in 10 years. So then, no, can you pay it off before the rate adjusts? And there's a couple things in there, but it took about 10 minutes. I think I actually make sure I cover the basics here. What did I have? Can you pay it off? If you take out the home equity line of credit and you don't take the money out and you're going to use that money to invest, can you make the investment that you're planning on if the home equity line of credit impacts your debt to income ratio? Because having the ability to borrow money on your HELOC that you have established, so if you can borrow $100,000, 1% of the amount of the HELOC counts against your debt to income ratio. So the lenders are thinking you're basically making $1,000 a month payment on money that you could take out. So if you had that impact your debt to income ratio, could you do the investment that you want to do with the HELOC before you do it? And the other thing is, if you're trying to use the HELOC as a reserve, that's a mistake, because I think the economic event that can make you need to use the HELOC as a reserve is going to be the economic event that makes the lender cancel the HELOC, right? So like there was a bunch of things that I covered there in those first 10 minutes, but to answer your question, no, I'm not using one and I don't plan on it. That doesn't mean that they're not good. My brother completely retired using the HELOC strategy. He had a paid off property that he bought cash, took out a HELOC, bought a property, fixed it up, turned it into a rental, paid it off, rinsed and repeat, until he got to 10 properties twice, because yay, divorce. And then he retired at 50, with 10 paid off properties that he just used a HELOC to get to. So there is a time it makes sense. and it has nothing to do with interest rates. If people are like, well, I'm not going to do a HELOC because interest rates are 6%, and they're not looking at the asset that they would be buying with it. Or if they say something, I'm not going to get a HELOC until interest rates are down to 3%, then they're going to make a mistake and probably use it for bad debt. It's what is the yield on the thing that I'm buying with the good debt that I create with the HELOC. That means rate, price, rents, return, whatever asset you're using that to buy. Don't do like the thing that me and Millennial Mike reacted to the other day, where the guy suggested taking out credit cards, get a loan against your car, max out a HELOC, and buy crypto. That is not my suggestion. Go. Wandering Doc says I can lose my entire principal on one deal every 10 and still do well. Although on things like this, usually that happens on 1 in 50. Nice. I missed something here on Nicholas. Here we go. Go out and see if I missed some more. Maybe my chat moved and I missed a bunch. Okay. Todd, howdy. This is just before Nicholas's stuff. So I'm in the process of building a fourplex for my house hacking goals. Very not aggressive, shooting for the stars. There's a term for that. If my construction numbers are right, Section 8 and 3 units would let me live for free and yield way above market average for my area. Nice. Does Section 8 pay above market average? And make sure you're basing this off of only bedroom count, not amenities like garage or parking or pool or anything else that you can have on there. They're just going to look at bedroom count. And yes, I think Section 8 rents are going up significantly this year, and I think they're going to go up more next year based on that link that Lumberjack Landlord shared, because they base their current rents off of some complex algorithm that they use looking at the last 5 years of rent. And now 2020 and 2021 are going to start to be factored into that equation. And those were years where we had massive rent increases. So nice. If it's your only one, I don't know that I would do all Section 8. What if there's a prolonged government shutdown that lasts long enough? The longest one I remember is like 69 days, and it didn't last long enough to impact Section 8. But what if it did last long enough and you had a couple months where you didn't get a payment? How would that impact you if all of your units were Section 8? That's why I like to do 1/3 Section 8, 1/3 military, 1/3 working or retired, kind of diversify your tenant base. Nicholas Massey, and this is why Matt answered your question, and I saw it to go back up to it. Have you or Lumberjack ever been, my stupid, you should put a commercial in here thing popped up, which I don't do. Ever been sued by a tenant? What's the process like if so? Lawyer or retainer? What about a dog bite? How to be covered? So you have insurance on the property. I have not been sued as a property owner. I have been sued over a dog in like 1 billion years ago. Did you know that when a dog attacks you and you have to not be nice to the dog and the dog doesn't survive, that you can get sued for that? That was a long time ago. It has nothing to do with real estate. So not been sued by a tenant, have an eviction and return attorney on retainer. So they're a real estate attorney. They're more than likely the one I would go through if I had a case where I was sued because of a tenant. But you might ask them, hey, based on this case, what's the type of lawyer that you recommend that I go with? But you have insurance in place to handle something like a dog bite. And they're going to show what you have to cover. I have an umbrella policy so that if anything went above the $300,000 of injury coverage on the property, then the umbrella policy is covered, or not covered, kicked in. A lot of times people will say things like, I don't want to own real estate because you can get sued. I don't want to own real estate because you can get called at 10 o'clock at night. You can get sued driving to work, doing the speed limit, if you somehow hit somebody with your car. You can get sued for all kinds of things. And so we have insurance in place for that. You can get sued if you're running a business. You can get sued as an employee working for a business. Like that we're just in a litigious society. I don't know that you're more likely to get sued as a property owner, but you should have to have that SWAN account, sleep well at night. You should have an attorney retained. You should have reserves. You should have insurance in place. You should not think that you should need an LLC for asset protection, because there is none with an LLC unless you have partners. Yeah, so that's kind of how that goes for me. Todd, Would you recommend going 100% Section 8 for your first house hack? I answered that in my commentary. So nope. Especially a fourplex. If it's a duplex and you're in one and the other side's Section 8, yep, that's going to be 100%. But with fourplex, I don't know that I would. I would probably get all of the units Section 8 approved because it's one location and you have to go through at least one inspection, maybe a second inspection if they come for a follow-up. And a way to kind of make that faster is the first inspection, when they find some things you need to fix, get their email and ask them if you can send a video of the repair once it's made to save a second return visit from them. There you go. Nicholas, what was your cash flow prior to refinancing at the pandemic lower rate? Oh, good question. So the payment went from $1,700 a month to $1,380. So it was like $300 ish a month increase after the refinance on each property. So I refinanced 3, so it was almost $1,000 increase to cash flow at the refinance, which does add a couple of years of payments at the end, but that's 2050 Dion problem, not 2020 Dion problem. Yeah, so I was probably, when I refinanced, so I was making about $5,000 to $6,000. Then refinanced, started making around $7,000, probably. Then added a triplex, added a duplex, stabilized the fourplex. Like it was at 2021 was the year where I was like, wow, this is starting to make some real money. And then 2022, it actually made like $40,000 more than I was expecting on a projected massive increase. Own rental properties over time. It's worth it. I just can't put it in any other words. Wandering Dog. Three amigos are top G's of real estate investors. Thank you. I think it's the REI Avengers. It's the top because we include Millennial Mike in there. Wandering Doc. Yep, I've only invested as a limited partner in about 30 private placements. 8 or 9 have exited profitably. Nice. So lumberjack landlord to Nick, they send me paperwork, call your insurance company first. Yep. Insurance company is going to want to protect their money as well. Wandering Doc, workforce large multifamily, core plus, value add, self-storage facilities, mobile home parks, ATMs. I like the last 3 because they historically do quite well in recessions. So do rents. Rents tend to go up in a recession. Oculus. If you partner with Millennial Mike, you could get great content discussion plans on your tube. If you don't agree, he might be coming at you with a vested in sunglasses. He could be. We have a couple of good debate videos coming up here pretty soon. That's actually going to be fun. Why do I have a whole bunch of texts? Make sure it's not a tenant. Okay, so I can share a little bit of Cody's story. Thank you for that. Yep, and that's something I don't want to talk about yet. So I have to answer that. It's a tenant. That's my 3rd text from a tenant this year. This is a busy month for me. And all this one is hey, I dropped the money off. It's so hard to self-manage. Don't do it. It's way too hard. William Kraft to Wandering Dot. Congratulations on your success. That is amazing. Let me know if you are open to strong cash flowing room to rent portfolios. Nice. There you go. Connect. Oliver. Howdy. Have you had a situation where another person wanted to move into the unit with an existing tenant? The tenant wants her daughter and grandson to move in due to her relocating from another city. What steps have you taken? Yeah, I've had that quite a bit. I've got a couple where it's literally roommate situations. The thing to know is I don't rent by the room, right? I rent the unit. So each person is on the lease, on the hook for the amount of rent. So if one person doesn't pay, and the other person says, well, I paid my portion, everybody's under the same lease contract. Adults have to fill out an application, so you get a credit background, an eviction background. You probably get to be able to verify employment. Make sure that the number of people in the house doesn't break the code in your area, which for most areas, not all, but most. So find out your local code. It's 2 per bedroom plus 1. So if you have a 2-bedroom, that means that you can have 5 people living there. If you have 3-bedroom, it means that you can have 7 people living there. So know your local laws, and it might be different in a different area. I have no problem with that. I actually kind of like the idea of tenants moving together. More opportunity for people to make money to pay the rent, more likely to pay the rent, less likely to move. And you will have people that will come and go. Make sure everyone understands that if somebody moves out, everyone left is responsible. So they have to qualify for the amount of the lease. So if you're doing income verification based on a multiplier of the rent, make sure that they qualify so that you're not discriminating against somebody who is not in the same marital situation. I'm not familiar with room to rent. Okay. There you go. You guys will connect on that. Andre, howdy. I'm considering getting a HELOC to either build an ADU or an existing duplex that will increase cash flow or use it as a down payment on another property to increase unit count. I don't know which route to take. So if you're taking out the home equity line of credit, the first thing is great. You're thinking, I have this, people call it equity. I call it the ability to create debt on an existing asset. So could you build an ADU or a duplex on your property? Is your city amenable to it? Check with contractors. How long is that going to take? You're going to have what's called a burn rate of while it's building. You have expenses every month that you don't just go, it's going to cost me $200,000 to build a duplex. So I need the $200,000 because now, does that also tie in sewer? Does it tie in water? Does it put in a septic system? Does it bring in, all the other expenses that can come up? Or is that just the plans to build that the person said, this is how much it's going to cost you? Then how long is the timeline on that? Versus if you could take out the home equity line of credit and buy something that will cash flow, will the cash flow on the thing that you buy justify the debt on the existing asset? So it has to have a yield that is beyond the debt that's going to possibly be on it if you use the HELOC as the down payment. If you use it to purchase the whole thing, because whatever your market is to do that, will the cash flow pay for the HELOC and pay it off before the rate adjusts? Like it's a whole kind of chain of thought to go through there, but you have the right idea of if you're going to create debt, what's the use for it? Like, how can I make money? Not, Dan, I'm going to take out $70,000 on my house and put on a deck and a hot tub. Like, I would totally pick on my friend Dan all day, every day, if he didn't also buy a rental and reach financial freedom and retire last year, 42 days later than I did. If he didn't do all that, then I would really pick on him. But instead I go, yep, you did everything great, except you spent some of the money on your personal house, which totally was his choice. He was still reaching financial freedom. He knew what he was doing. I'm just being sarcastic and picking on my friend. You're thinking, how can I put this money to work? Not what can I do with this money that's fun? We're going to make my life better. You're going to make your life better by putting that money to work. And then picking which one totally depends on your market, your goals, your timeline. Like there's a whole bunch of stuff there that doesn't come out from a random guy on YouTube during a live. But it's a good question though. And then I see the chat here. I think I moved it. Dion, if you have $750,000 allowance you can use on a VA loan and could move anywhere in the US to get it going, what city would you move to and why? So you have $750,000 on a VA loan, which you can use on up to talk to lenders, because most people are going to say up to 4 units, but some lenders will go to 5 units on a VA loan. So you can look at some 5-plexes if you find a lender that's okay with that on a VA loan. So start with that. Where do you want to live? Right? Do you like the climate of the desert? Do you like the climate of skiing in the mountains? I like Washington because I love the rain. I grew up in the high desert in California, and literally one of my reasons for joining the military is I wanted to get in the Marine Corps and get out of the desert. They put me in 29 Palms in Kuwait and Saudi, and like all the places where it's just dirt, right? And so I was like, I get out and I was like, where does it rain? And I didn't want to move to Siberia where Matt lives. So I moved to Washington where it rains a lot. So that's where you look, and then you look at maybe you look at the politics of the state, and does it align with you? Are you going to feel welcome there, or are you going to be like me in Washington, where it doesn't align with you, and it's actually one of the things that bothers you about the state? But there are high cost of living areas in almost every state, and then you just take that high cost of living area and you draw a circle around it, and as you go out, you're going to find an equilibrium between prices and rents where it starts to make sense. You can almost do that everywhere, like. I live in the state where Seattle is, but I had to go out to Tacoma and Olympia to find the places where I can get the good cash flow on the rentals and stability with several economic drivers, right? Zuber lives in Sacramento area, and he went out with that circle and until he found Fresno, this place cash flows. So he invested there. So you can do that in pretty much any state. You can find the place where there's an equilibrium. A lot of people say, oh, I can't invest in California. Well, Zuber's doing it. My brother invests in Kern County, which is just north of LA County. So you get the LA County commuters, the LA County prices and rents almost, but Kern County prices for properties, making cash flow. Not easier, not easy, but easier, right? So it's not easy to find it, but it was easier than to find it in LA. And you don't have the eviction moratorium going on. So it doesn't matter what state you pick. It matters, do you want to live there? And because VA means owner occupied, right? You're going to have to live in it for at least a year, or intend to. Don't commit fraud, actually intend on living there for at least a year. Know that you can have more than one VA loan. So maybe buy something like a duplex for 200,000 or 300,000, and then a year later buy another one that is closer to where you work, or in a better school district, or has 3 bedrooms each side instead of 2 bedrooms each side, so you can have a justifiable reason for using your VA loan again. If you're a veteran and you use your VA loan, every time you use it again, your origination fee goes up to like 3 or 3.5%. So there's a fee to use it again. And I think it goes up to that, and then it stays there. So every time you use it again, there's that fee. If you have a service-connected percentage, a VA disability rating of 10% or more, then that origination fee is waived. So you got to know the rules. That's kind of what I would do. I still have my VA loan available, right? I still have full eligible. I've never used the VA loan. I wanted to put some money down. I didn't want to have, so in about 1999, yes, there were people alive that long ago, I purchased a house with a first-time buyer program where it was zero out of pocket. They wrapped closing costs into the loan. So I bought a $98,000 house on a lake in Yelm, Washington. And it was $104,000 when we finished the loan off. So it was mortgage was $104,000. I was underwater when I bought it, and it would have cost me 8% to sell. So I was underwater, and I had an adjustable rate mortgage. It was awesome. I was the cause of the 2008 housing crash. Very sorry, everybody. Make sure I'm not missing any super chats here. Sorry. Okay. So run through the chain really quick to update like dividend day. Like I caused a housing crash. I didn't want to be in that position again. I barely hung out. I hung out a couple ways. One, I held on to the house through the divorce. I refinanced to $150,000 with an adjustable rate to give my ex her portion of equity before I knew about the debt in my name, which was awesome. I'm gonna have to deconstruct my own segue here. Hang on. And that story always makes me want water. So I was underwater on the house. Then the housing crash happens, and I had an adjustable rate mortgage. I barely held on to it through the divorce, barely held on to it through getting laid off from a police department. When an adjustable rate hit, like everything sucked. So I've had the VA loan available to do, but I don't ever want to be 100% leveraged on a property when I only had, the smaller portfolio. Now that I have about 40% leveraged on the whole portfolio, if I buy a VA loan, it's still going to have me at 50% or less total loan to value on the whole portfolio. So I'm considering doing it now, which is something I hadn't done before. So if it's your first one, understand that you're buying it long-term, right? If you sell this in the next couple of years, it's going to cost you money to offload the asset because it costs between 6 to 8% to sell a property. And if you buy it and say the market, like Zuber predicts market kind of being flat, Lumberjack Landlord predicts it kind of going down 5 to 10%. So now you're really underwater. I project inflation to be a thing. We printed more currency in the last 2 years than the last 200 years. So I think inflation alone is going to make it cost more currency to buy the assets. So I think they're going to go up, but I don't think they're going to go up enough for you to be able to sell it if you had to. And if you're using your VA for a build, like what's the timeline? Where are you going to live in that amount of time? Like there's a lot to consider there. So I would look at an existing small multifamily in a market that would cash flow, where I wanted to live, and rinse and repeat once or twice, live there for a year, use it again. Be ready for the origination fee to be more if you don't have a service-connected disability. That's what I would do and why. Hope that helps. And then I saw Nicholas Massey. If you use your homeowner's insurance for a leak or something, do all your rental property premium go up or just the one property that had the claim? Great question. I'm going to have to find out for sure. A couple of things about homeowners insurance. I have my deductible set as high as possible. So there were some times when I got the package and $5,000 was the highest deductible. There were other times that 10,000 was. So I have a few properties at 10,000 deductible and some at 5. I will not use insurance to pay for something unless it's probably 30,000 or more. So the deductible plus a multiplier of it, because the homeowner's insurance on the place that has the claim is definitely going to go up. And for 5 years, no one's going to insure you except that insurance company. The only way to buy something sometimes is going to be able to use lender-placed insurance, which is 2 or 3 times what regular insurance is going to cost. So it creates a lot of issues. So unless I have a major slip, fall, injury, or a complete burn down, I'm not using my insurance. So I go for the highest deductibles as possible. I don't know if a claim on one insurance impacts all of them, but it does impact your ability to get insurance on any other kind of property, because they go, in the last 5 years, have you had a claim anywhere for any reason? And if you had, you're pretty much not insurable except for by that company. And my rates tripled. 2006, I had a tree from a neighbor, hit my house, wasn't an investor, I was a home buyer. Broke some windows. It was like $1,300 or whatever the claim was. And I'm stupid, so I had the insurance pay for it. And then my rates tripled. And until 2011, no one else would insure me. Not doing that again. Good question, though. Mark, howdy. GM, howdy. If one has 4-unit property with 30-year fixed rate debt in a high cost of living, rent controlled area near their primary residence and rents around 50 to 60% of market value, is the best option to get out of the form of a 1031 exchange and into a property in a more landlord friendly state and deal with managing from a distance, or just hang on to that loan? Understand your local laws. If you owner occupied that property, does that immediately remove your rent control? A friend of mine owns a small multifamily in Bend, Oregon, where rent control exists. Doesn't apply to small multifamily that you house hack. And there are areas where it doesn't apply to single family, or it doesn't apply to you if you have less than 6 units or 10 units or whatever that local state requirement is. So make sure it applies to you. And the option is, if you owner occupy, rent control might not be a thing. If you're 50 to 6 below, what's the cash flow? Area market rents set what your rents could be, but if that's where it's at, based on what you paid, how long you've owned the property, what your debt structure looks like. Yes, a 1031 exchange to another market to make yield is possible, but do you want to build a team, learn a new market, go through all those steps? What's your yield looking like based on what you have in that property? I have a paid off property. I'd probably get twice the yield if I sold it in 1031 into something else, but I don't, because I have a dialed in tenant that hasn't talked to me since June of last year. And at that point, I think it was the one text I got from her last year in total, right? I don't want to mess with that tenant. She takes care of things. Rent's always paid. It's Section 8. Her portion changed, and she actually, that was what the text was about. She actually pays her portion. Have no problems. So there's a lot to consider there. I haven't 1031'd. Does the rent control apply to you? If it does, what's the maximum that you can increase? It's one of the drawbacks to having a rent control area is the landlord is forced to raise the rent the maximum allowable amount every year, or they quickly find themselves in a situation where I have to sell this asset. And then basically people are going to do, well, I'm going to do an eviction because we're going to do a rehab. Like you got 60 or 90 days or whatever it is to move out because I'm going to move in, or I'm going to rehab the unit so that I can get it to area market rents, because if I don't, I'm going to lose money. Like you force tenants to be moved. You force tenants to have the maximum allowable increase every year. You have a lot of different things there. So find out if it actually applies to you. Do you know of a market where you could get a better return? And not just, I think I could get it. I mean, if you made the offer at the amount you were talking about, do you have a place where you know someone that you trust, or you know the neighborhoods, or used to live there, or willing to move there, whatever it takes to actually stabilize that and know that you're not getting ripped off and buying a bad deal because you call something like Gary, Indiana, and tell an agent, I have California or New York money and I want to invest there. They're going to send you the best deal that all of the local investors passed on for a good reason, right? So there's a lot there. Hopefully I gave you some things to think about. Figure out a different option to go there. Monica, please everyone press the like button. Thank you. I appreciate it. Remember, every time you hit the like button, an angel gets its wings. All-nighter hider. I'm finally done with work. Headed to dinner now. Thanks for the ear candy. Thank you. I hope that was good. We're probably going to be wrapping up here in a few minutes. I'm going to get to the last couple of questions. Monica, I was told I am not able to use my VA loan more than one time. Well, you were lied to. So find a new lender. You can use it many times, and it's not just based on what amount you have available. Loan limits were taken away in 2020; they just disappeared. A lot of things changed with the VA. Some people are told you can't use your VA loan until you get out of the military. That's not true either. There's all kinds of things that you can do that, and we are often as veterans told the wrong crap when we go to get out. So I'm glad that you brought it up. Now you know to go to a lender and say, why was I told this? Maybe you have a lender that did loans when that was a thing, and they haven't kept up with training. Howdy, Robert. William Craft, Wonder Dog. I don't have a website. I'm doing this myself. I met more. So you guys are talking about the rent by the room stuff. Hopefully you guys can share each other's information. Matthew Paris. Howdy. I waited until my 5th property to use my VA loan to purchase a new primary, which is paid for by rents on the property we moved from. Brilliant strategy. It's probably what I'm going to do. I'm probably going to use it to buy a 4-plex, live there for a year, and then use the cash flow from that unit as what my mortgage should be on the house that I move into. Loose plans. And everything Dion just said on VA checks out based on my loans. Awesome. Great. Perfect. I'm going to give just one more minute here to see if there's any questions that pop in at the end. Should be doing a live stream this Friday on the Lumberjack Landlords channel, depending on his availability. So hope to see some of you there. We do a random midday live stream, and then we have a video that came out today on his channel if you released it, and we did some Three Amigos stuff this morning. Millennial Mike and I will be doing some shorts and maybe some content videos at the Cody and Christian Multifamily Strategies event that's happening this weekend in Union, Washington. So I'm going to put my email in the chat if you want more information on that. I can connect you with Hannah, who's doing the coordinating for it. So Lauren, if you haven't gone to bed, there's my email. You should already have it. But reach out and I will connect you with Hannah. Dividend Dave to Dion. Why are you so awesome? Because your standards are incredibly low. There you go. Tony, howdy. Good to see you. Thank you for the Christmas present. It was much appreciated. I have only used my VA loans to purchase my 2 properties. It's a higher standard, but the ability to utilize it to enter the path towards financial freedom is wonderful. Great job and awesome. Yeah. So there you go, Monica. Somebody telling you can only use your VA loan once. Tony's done it twice. Dividend Dave, will that event be filmed or recorded? So I don't know about the whole event because it's Cody and Christian's thing. I know that when me and Mike are presenting, we will. It's hard setup. I have 2 mics, so me and Mike will have a mic. It's a lot of mics in 1 minute, but we will be mic'd up, and I will do a live stream for our talk probably. And like when I did Zubers, I did that with mine too. It's probably not the best angle, format, content, lighting, whatever you normally look for on YouTube. But that portion of the event is mine. So like I'm doing it, I could share that. I can't share their other stuff. So I don't know if they will. They'll probably have some of it on their channel as well. Yep. Thank you, Tony. Awesome. Cool. Well, you guys are all amazing. I hope you have a week full of wonderful. I'm thinking the video that's coming out on Thursday is going to be, what is the one that I set up to do? No, that was the HELOC one. So we did that. That's what I did today, right? Somebody with a better memory tell me. Oh, when does good debt turn into bad debt? That should be coming out on Thursday. Until my next video, thanks for coming to my Dion Talk.